Welcome to the European Market Open. A minute to go until the start of cash equity trading. I'm Tom Mackenzie in London, and here are your top stories. Market rout. US stocks suffer their worst sell-off in almost 2 years as growth fears pummel sentiment. European futures point to losses at the open. Supply chain shock, a warning from Cisco, and inflation pain for retail hammers sentiment. Plus, coming up this hour, don't miss our conversation with the head of Europe's answer to Uber. Markus Willig, Bolt CEO, joins us in half an hour's time. Let's check in then on the futures following that rout that we saw in US equities yesterday, particularly pronounced. The S&P 500 closing down around 4%, but the Nasdaq lower by more than 5%. That concern about the big retailers, particularly Target, dropping to levels that we haven't seen since the 1980s. The biggest stock drop for the S&P 500 in 2 years. The futures pointing lower, and here's the picture then for the FTSE 100. Just in the first few seconds, lower by about 0.1%. That will continue to adjust, of course. You also heard from Chicago Fed President Charles Evans saying he would like to see rates to the neutral level and then possibly pausing. We have concern when it comes to inflation at the corporate level with the questions around Target and the ability of these companies to absorb higher costs and margins. And then on the geopolitical front, one country that stands out, particularly in emerging markets, is Sri Lanka, defaulting for the first time in its history on overseas debt. Implications for bondholders, implications for other EM markets. The German DAX is currently down 1.3%. The FTSE 100 now lower by 64 points, or 0.9%. The CAC Cajon lower by more than 1%. The Spanish IBEX down 73 points. Let's flip the boards and see how things are playing out across these various assets. Then looking ahead to the US, weighing up what's happening within the bond market. You saw a bid, of course, part of that safe haven move into treasuries yesterday. The S&P futures pointing lower by 0.3%, so building on their very heavy losses we saw yesterday. Not much dip buying sentiment, at least at this point. The 10-year is currently at 288, not much movement there after a bid for that benchmark yesterday across the yield curve. In fact, the Bloomberg Dollar Index is currently range-bound, and Brent, $110 a barrel, up 1.2%. We continue to look at what is happening in China around the COVID-0 policy and the demand implications there. We'll switch it on and see year-to-date what is happening then across the US markets in particular. Wells Fargo coming out and saying it is now their base case that you will get a mild recession within the US. Year-to-date, the S&P 500 down almost 18%. You are close to a bear market now with these US stocks. The Nasdaq, of course, tech-heavy, particularly the profitless parts of that market have been particularly badly hit. Some parts down more than 40%. It is down 27% in terms of the broad benchmark that is the Nasdaq. In terms of some of the individual names that were really badly hit yesterday, we'll switch on and see how things were playing out. Cisco, a remarkable story there, and reminder of the importance of the supply chain constraints that we're seeing across China, and that was part of the package with Cisco. Target, of course, and the inability to continue to hold on to margins as a result of higher input prices. Year to date, down 30% for Target. Of course, it did perform so well during the pandemic, now losing on the back of that. Apple, down 20% year to date, and Cisco, again, on the warning around supply chains coming out of China, down 23% year to date. A significant drop for that company just in yesterday's trading. Let's go over now to Bloomberg MLive Managing Editor Mark Cudmore. Mark, I know that you're looking at central bank balance sheets, and this is part of the mix, that withdrawal of liquidity, tighter financial conditions.
Yes, absolutely, Tom. QT from the US hasn't even started yet, and yet we're already seeing the fastest shrinkage of central bank balance sheets in global terms that we've ever seen. So this line is the combined dollar value of the combined balance sheets of the four largest central banks in the world, the Fed, the ECB, the BOJ, and the PBOC. And it has just fallen in April by $1.1 trillion. That is by far the largest shrinkage ever. And March was already the largest decline since January 2009, so the largest decline in 13 years, and then surpassed again in April. So no wonder stock markets and equity markets and speculative assets are seeing such pain at the moment, because really it was this explosion in central bank balance sheets after the pandemic. We basically went from being roughly 20 trillion combined up towards 32 trillion combined in the space of a very, very rapid period of time that really exploded financial assets around the world. And it's this reduction that's going to cause massive pain. And remember, the Fed hasn't even really started QT yet, let alone the rest of the world. Now, the other point about this is that the qualifier is that part of the reason this is coming down so fast is FX impacts. The dollar has been strengthening, and therefore the value of the ECB's balance sheet, the PBOC's balance sheet, the BOJ's balance sheet is shrinking in local currency terms, or sorry, shrinking in dollar terms, I should say. So part of this is FX impacts. But that FX impact reflects a real tightening of financial conditions on global markets, and that's why asset prices are seeing such pain. So keep an eye on this number over the next couple of months. This explains a lot of the pain out there.
Bloomberg MLive managing editor Mark Cudmore pointing to those tightening financial conditions, even, as he says, before the start of QT. Just flagging a redhead that's crossing the terminal, because we mentioned this at the top. Sri Lanka officially defaulting on its overseas debt, and a redhead now crossing saying that Sri Lanka says that the debt restructuring could take about 6 months. Just as a reminder, in terms of who is holding that debt among the list is Fidelity, BlackRock, UBS, amongst others. Okay, let's get back to what is happening across these markets then. That rout yesterday, the steepest rout in almost 2 years for US stocks, and here's how investors have reacted.
We are playing it more conservatively than more aggressively, both on the fixed income as well as on the equity. So to your point, dialing down areas that are high yield or areas like that.
It's a different phase of investing. It takes different approaches. Your best approach is actually to de-risk portfolios, at least back to neutral to some degree.
I think today is a little bit more validation that the consumer is not as strong as we thought it was, that we're starting to see inflationary pressures really affect the earnings of companies.
The consumer is getting weaker from the bottom level up, so from the lowest income up, and it remains to be seen where that stops.
Okay, let's get into the key market drivers with our Markets Live editor, Noor Al-Ali, and Charlotte Ryland, co-head of investments at CCLA. Great to have you both in the studio. Noor, let's start with you. Are we seeing capitulation now in these equity markets?
I'm afraid I'm going to say not yet. I think we're still going to see a bit more hurt. I mean, if you look at implied volatility for stocks and you compare that with high yielding bonds, so that's basically junk bonds, you'll see that in fact it's much higher because investors are looking to pay higher risk premiums for stock at the moment. That's how volatile they are, even by junk bonds perception. So I think we're still going to see a bit more pain. We might see some dip buying, definitely, but I don't think the market has shown enough structure or strength for us to carry through just yet.
Charlotte, let's bring you in at this point. Is this the earnings story that was propelling, at least underscoring the thesis for the bulls out there, that this was part of the mix? The earnings story, the strong consumer with the balance sheets holding up. Is that now starting to crumble, the earnings story, when you look at the likes of Target?
I think there are a couple of things going on with the consumer. I mean, they've also got the fact that people are beginning to spend differently than they were over the last few years. So when the pandemic, you're locked down in your house, you're buying certain things, consumer durables in particular, perhaps some of the things from Target. Now people are getting to spend more on services. You know, we're certainly seeing restaurant figures have been improving, holiday bookings have been improving. So I do think the consumer is not spending altogether, they're just spending differently. And that's a big problem for something like in Target where they've got their inventory ordering wrong. But I think if we move forward, yes, as the interest rates continue to move up, as those inflation pressures remain, I think you could well see the consumer beginning to weaken off.
I need to put the MLive Pulse survey question to you. This is the question of the day. We do this survey on a weekly basis. Where is the bottom? Where do you see the bottom for the S&P 500?
I'm not going to pick a figure, but I mean, I think certainly we look at earnings multiples, and you've seen it going down to about 17 times for the S&P 500. You know, it was down at 15 times pre, at similar levels when you had sort of much higher interest rates. So, I think we still have further to fall, I would say, just in terms of the derating.
And Noor, on the bond markets, is this where you want to be finding safety now? Is there opportunity now within these bond markets?
I think the there are two schools of thought here. Bonds, definitely havens. I think also you saw FX yesterday. You know, the Japanese yen, the Swiss franc, and the dollar.
The yen is back. The yen is back.
I mean, let's just hold our breath. I'm not going to say much because I know that Mark Cudmore is a big FX man, so I'm going to leave it at that. But I think you will definitely see some rotations back into bonds, but to what extent? I mean, we know that June is the official start date for quantitative tightening out of the Fed. It's all about money supply, and there's not going to be much of it soon. So I'm a little bit concerned. So I think it's all about risk and playing the volatility game at the moment.
And Charlotte, just before we get to break, on the question of China, on the question of emerging markets, Sri Lanka is its own case, but of course there are overlaps when it comes to the question of inflation. Are we underestimating the risks from the supply chain challenges coming out of China? The shock, of course, for investors who had exposure to Cisco on that warning. How much of this is continuing to play out in the markets?
I think it continues to be a huge issue in terms of China, in terms of the consumer, but also in terms of actually getting their business running. And we still have got no clear idea of when the government is going to step away from this COVID policy. And while that remains in place, it just makes it a very difficult situation.
It's that lack of clarity out of China. We continue to watch, of course, around the COVID zero policy. Bloomberg's MLive editor, Noor Al-Ali, thank you for walking through some of the key themes. Staying with us, Charlotte Ryland. We'll get some of her calls after the break, co-head of investments at CCLA. Coming up, as global economic ties unravel, a new age of scarcity appears to be dawning. We will discuss that next. This is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Welcome back to the Open this Thursday morning. We are 12 minutes into the European trading day. You're seeing losses of more than 1% across European equities, particularly pronounced when it comes to personal care, retail and autos, all down by more than 2% this morning. Every single sector in the red as investors digest, of course, the significant losses that we saw in US markets yesterday, the continuing concerns about inflation and what it means for central banks. Now, the ties that bind the global economy together and delivered goods in abundance across the world are unraveling at a frightening pace. Russia's invasion of Ukraine and China's COVID zero strategy are disrupting supply chains, hammering growth and pushing inflation to 40-year highs. The latest example came from Cisco yesterday. The company spooked markets with a warning that Chinese lockdowns and other supply disruptions would wipe out sales growth in the current quarter. Joining us for more is our international trade reporter in Geneva, Bryce Barshik, one of the authors of today's Big Take story. Bryce, are the ties that bind the global economy unraveling, and to what extent?
Yes, I think that's right. What we're seeing now is essentially a deep rupture in the globalization that we have experienced in the last 30 years. The combination and the cumulative effects of COVID, lockdowns, China's zero COVID policy, supply chain disruptions, and now the war in Russia and Ukraine are causing basically major players in the economy to reevaluate what is important. And you're seeing a shift from globalization to a new phase of globalization where democratic regimes are going to friendshore their production away from authoritarian regimes like China and Russia.
I know you've touched on that, and I want to unpack it in a little bit more detail, because it is a fascinating element of all of this, and we're witnessing that rupture between market democracies and then the likes of China and Russia and the authoritarianism that we see at play there. What is the biggest impact going to be as a result of those divisions? And certainly in China, you're seeing this increasing focus on being able to build out domestic sustainability and resilience.
Right. So if you think inflation is bad now, wait until the next phase of globalization to see what it has in store. You are going to see a less productive world and a poorer world with higher costs. Bloomberg Economics ran a simulation where they added the equivalent of a 25% tariff on the $6 trillion worth of goods that are currently exported between authoritarian regimes and democratic regimes. The result was a 20% decrease in global trade. Now, for scale, that would reverse the trend of globalization that we've seen over the past 3 decades and put us back to the period before the World Trade Organization allowed China to join.
I mean, it's a fairly apocalyptic forecast, but Russia and China are very different beasts, even if they are authoritarian governments that run those countries. We cannot unpick ourselves from the Chinese economy. We are overly reliant. We're too reliant in terms of the exports that we demand out of that country. We cannot impose the same kind of restrictions that we have done on Russia. So is there an argument that maybe this is an overly bearish forecast?
Absolutely. This is the black swan extreme forecast, but we can't rule it out. You know, what you're seeing with Cisco is basically the real challenges of operating and concentrating your production in one market. When you hear the CEO talking about geographic resilience, he's talking about moving production to a more diverse base rather than just one country. This aligns really with what U.S. Treasury Secretary Janet Yellen has been talking about with friendshoring, essentially taking production out of nations that are either considered to be authoritarian or, in the case of Russia, violating international norms, and moving them to nations that have a more resilient and friendly base for democratic nations.
Okay, Bryce, thank you for that analysis with today's Big Take. Let's bring back Charlotte Ryland then from CCLA. Charlotte, how do you want to be investing in a less globalized world?
I think, you know, as your previous caller was talking about, you know, it is an inflationary pressure that's going to continue being there. And having had 30 years of falling inflation because of globalization, because of the ability to offshore production, because of the ability to, you know, use those benefits of trade, I think that will be a continued headwind and probably mean inflation is higher even once we've got some of these short-term pressures out of the way. And I think it therefore means that you're going to have to find companies that have got a degree of pricing power, have got, you know, decent gross margins, can actually grow beyond, you know, what is going to be probably a more difficult environment.
Which sectors stand out for you within that pricing power story?
I think for us, you know, still the healthcare sector looks very interesting in terms of the innovation you've got there, the fact that, you know, governments will have to continue to spend on healthcare, so, and with an aging population, of course, we're going to have to continue with that. And I know technology is not flavour of the month, but there remains, you know, some very interesting and cash flow generative businesses within that. I mean, clearly people like Cisco having headwinds at the moment, but longer term, it still looks an interesting area.
Within the technology ecosystem, where particularly would you be looking?
And we're much more focused on sort of the software names, so the Microsofts of this world, which of course is the Azure and the cloud computing, as well as things like Adobe. So we think those continue to be sort of interesting businesses.
What do you make of the shift that we've seen in terms of the flows from cyclicals to defensives just in the last few weeks and months? Do you see that continuing? Do you want to follow that, or is that overly done?
I think there is a bit of a concern in terms of the valuations of some of those defensive names, so some of the telcos, some of the sort of the data services companies, like so the Relexes of this world, for example, trading on quite elevated multiples for them. But then as soon as we have this uncertainty over the economy, signs of the consumer rolling over, you can see why people want to be in those sort of steady stocks until that economic picture is clearer.
The FTSE 100 has provided some level of security within the last year, at least year to date, versus other major indexes. Do you expect that to continue? Do you want to increase your exposure to the FTSE 100 because of that international exposure? It's not overly reliant on the domestic economy?
I think the FTSE 100 has been going up because it's very dominated by commodities. It's dominated by oil, it's dominated by mining companies. So, our view is that, you probably, as we move through, if we have a slower economy, that will be bad for the oil price. If we have increased supply from places like the US, that'll be bad for the oil price. To assume it continues rallying upwards, we think is quite a dangerous assumption. And these are low return on capital businesses. So we think, they will probably return to normality.
Before the break, you were talking about the shift from the consumer away from durable goods towards services, leisure, arguably as well. Do you want to be following that as an investor? Do you want to be investing in, for example, travel and leisure and reducing exposure to the durable goods components?
Yeah, I think that continues to be a trend, at least for this year, while people still have got, a degree of savings left over in their pockets, that, they will be treating themselves, they will be going on holidays, et cetera, et cetera. So, some of the hotel stocks, for example, we think look reasonably attractive.
Attractive for now, Charlotte, it seems,
yes.
But maybe question marks over what happens next week as the balance sheets of households across the country, globally as well, get pulled down. Charlotte, thank you very much, as ever, for your analysis. Co-head of investments at CCLA, with some interesting calls there. In terms of what's happening, we continue to watch, of course, the G7 and how that is unfolding. You do have the German Chancellor there live, of course, the Chancellor Scholz speaking in the German Parliament, and he's reiterating his strong support and Germany's strong support for Sweden, Finland, and those NATO bids that are currently being held up by Turkey and Mr. Erdogan. Scholz saying that we must better align European defence systems. Germany will secure and strengthen its defence capabilities. Ukraine and its allies will not accept a Putin-dictated peace. That from the German Chancellor. We will forge closer links among European defence firms. So some analysis there, or at least some additional colour from the German Chancellor, details around how he's thinking about European defence, German defence, of course, amongst and within at a time of pivotal change for Germany when it comes to defence spending and how it's thinking about shoring up its military. Okay, coming up, we look at Tencent's disappointing earnings and its warning about China's tech crackdown. It ain't done yet. That is next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Welcome back to the Open. We are 23 minutes into your European trading day. You're seeing losses of almost 1.5% across European stocks. Every single sector in the red. Personal care, retail, autos, consumer products, financials, all down by more than 2%. Investors weighing up that earnings warning then from Target, a company that is unable to maintain its margins. This really highlighting the cost of inflation for corporates. And is the earnings story now starting to crumble as, of course, central banks turn more hawkish? When it comes to the earnings story, one standout name within the Chinese space, Tencent, the owner, of course, of the super app, warning that it will take time for Beijing to wind down its crackdown on the tech sector. We're seeing losses for Chinese tech stocks today. Just checking in on those companies listed in Hong Kong, down 4% as things stand, following disappointing earnings in the first quarter from Tencent. Joining us now is Bloomberg's Catherine Nye. Catherine, we're seeing those losses then, as I mentioned, within those tech earnings as a result of the warnings from Tencent, the executive team there, saying that, look, the crackdown, it hasn't come to an end yet, and it's going to take some time before the positive rhetoric from some of these officials actually translates into meaningful action on the ground. What are your takeaways?
Right. So, I mean, this is such an interesting quarter, right? Going into Tencent's earnings, and this is, you have to remember, just a year ago, we thought Tencent was going to be the next trillion-dollar, whale. Like, we thought this was going to be the company, and look how things have changed a year on. Going to these earnings, we knew that it was going to be bad. And taking a quick look at the numbers, I mean, net revenue falling, by half, sales being, up a tiny bit, the slowest revenue growth since 2004 listing. We knew it was going to be bad, and I think actually a Bernstein analyst said it best. In a quarter, what we knew was going to be bad, when every single sort of key metric falls below estimates, that's a real kick in the shins. And I think that is a perfect way of describing this. We knew it was going to be bad. We're looking at it and we go, wow, this is actually bad, much worse.
Yeah, a real kick in the shins. Not only getting any uplift either from the lockdowns and any pickup in gaming, advertising likely to be squeezed, of course, as the broader economy comes under pressure. What are investors focused on out and beyond this set of earnings?
Correct. So, China tech stocks in general have not had very much a good fortune in this last year. It's just one sort of headwind after another. You think about geopolitical concerns, you think about the crackdown, and now the Shanghai lockdown, right? Now it's the lockdown that's gone from Shanghai and Shenzhen into Beijing and many other major cities. That is exactly, this is the big sort of elephant in the room right now, the lockdowns, and if they will ever ease, and particularly in the short term. A lot of this, in terms of ad revenues, in terms of payments, all of these things really hinges on the lockdowns. And so investors are keenly focused on how China responds and if there will be any easing, not likely, of this COVID-0 policy.
Yeah. And for now, no clear roadmap on that front. Bloomberg's Catherine Nye, thank you for breaking down those 10-cent results and the broader implications. Coming up, much more analysis on these markets. Stay with us. This is Bloomberg.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
However you get your news.
This is Bloomberg Daybreak with Link.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Welcome back to the Open. We are 30 minutes into the European trading day, and here are your top stories. Market rout. US stocks suffer their biggest sell-off in almost 2 years. That's as inflation pummels sentiment. European stocks fall at the open. Growth warnings abound. JP Morgan is the latest bank to slash its forecast for the US as Standard Chartered downgrades China. Plus, Tencent adds to the pain. The tech giant leads declines in Asia, warning the industry crackdown will not end quickly. Let's check in then on these markets after the rout that we saw in the US yesterday. Concerns around the growth picture, as we were saying, Standard Chartered downgrading its view on China. You had Wells Fargo saying now its base case is for a modest recession in the United States. And then there was that earnings warning pronounced from Target, and that rippled across the markets yesterday. Is the earnings story now starting to crumble? One of the pillars of support that many there had pointed to now in question. In terms of what is happening across the European space then, that handover from the US translating into losses of 1.6% across the benchmark. The DAX over in Germany down almost 2%, down 261 points. The FTSE 100 also lower by 1.3%. We know, of course, that the UK is grappling with inflation that we've not seen for about 40 years at 9% on the data that we got out earlier this week. We'll switch it up and see how things are playing out then across these sectors, and every single sector today in the red. The least bad comes to energy and healthcare. At the bottom of the list, you've got things like consumer products, retail, and autos. Financial services also taking a big hit. A number of those sectors down more than 2%. The Fed's Charles Evans saying he wants to see a neutral rate for rates in the United States and then possibly a pause. And of course, we heard earlier in the week Jay Powell saying that he could and would be happy to go above the neutral rate if needed to get inflation down. Talking of which, this is, of course, rippling across the Treasury markets. And today and this morning, you've seen a modest bid for US Treasuries, gilts and bunds as well, building on those moves that we saw yesterday. 2022 shaping up to the most volatile year for Treasuries in over a decade. The yield on the 10-year US note is on track for the widest swings, also wild swings, since 2009. Joining us now is Bloomberg MLive currency and rate strategist Ven Ram. Ven, what is driving the volatility in Treasuries? How much of this is down to uncertainty about the course of the Federal Reserve? And is it likely to last?
No, I think we are kind of going to abate on volatility, Tom, because I think that we have seen the peak of volatility for the first half. And I think we haven't, if you look at the twos range, which is the most important range for across the maturities because of what the Fed is doing. We haven't done really very much on the 2-year maturity this quarter. And I do think that the Treasury volatility is likely to abate. Why do I say that? Because the markets are pretty much priced in a stiff Fed pricing trajectory. We are pricing 200 more basis points in the remainder of the year, and that's been unchanged for the past few weeks. And I don't think that's going to change very much. And therefore, I do think that we are done on volatility for the time being. Later on, as growth slows, we will get a renewed bout of volatility, but we are not there yet.
What does it mean for yields then? Are you seeing them capped at kind of these levels? Do we get back above 3% for the 10-year later this year, or is it capped below that level?
I think we may do around 3 to 320 on the 10-year, but on the 2-year, definitely we have topped out for the year. I've been saying that for the past couple of months, and that is, I do think that the 2-year is going to be bobbing around between 260 and 280 somewhere over the next few weeks, and I do think that it will come off a bit after that. And the 2 years, the front end is completely priced in the Fed. It's not going to go anywhere. The long end, because of the bad.
Okay, we appear to have lost Venram's line. This happens, live TV, we have tech problems. We'll try and re-establish the connection with Venram to get his views on what is happening across these treasury markets. He's also got analysis on gold. Gold currently trading at about 1,800 an ounce, down 0.2%. Of course, towards the end of last year, there was a view that maybe gold was a place you want to hedge amongst and within the geopolitical risks that we're seeing. But now the view is that with inflation and yields up, gold is not a place you want to be. But we know that Venram has some analysis on this. We'll try and re-establish the line and get that at some point. Currently, the markets, you're looking at losses of 1.6% across the European space. Coming up, demand for transport solutions is surging. That's as countries emerge from the pandemic. We speak to the head of mobility firm Bolt on how they are planning for the post-pandemic future. That is next. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
welcome back to the Open. We are 38 minutes into the European trading day. You're seeing losses across European equities of now 1.7%, and US futures not looking pretty at all after the rout that we saw yesterday. Of course, just a reminder that we saw the S&P 500 dropping, seeing the biggest hit for almost 2 years, the biggest drop in almost 2 years of 4%. The Nasdaq ending lower by more than 5%. The futures now, S&P E-minis looking to build on that rout, down more than 1.2%. The Nasdaq futures lower by 1.5% as things stand. We had that warning, of course, from Target around earnings. That's leading to a lot of caution. Of course, continued calculations around recession, that call from the likes of Standard Chartered and Goldman Sachs on China, and Wells Fargo now saying that for the US, at least a mild recession is the base case. Let's get back to Bloomberg MLive currency and rate strategist Ven Ram. We've re-established the line. Ven, I want to get your views on gold. You're saying that there's relative resilience within the yellow metal, even as yields and rates move up.
Absolutely, Tom. If you look at the real rate space, the 10-year real rate space, which is one of the biggest drivers for gold, we have moved higher by 125 basis points. Now, that's a phenomenal shift that we haven't seen in years and years. Now, yet, if you look at gold this year, it hasn't fallen that much at all. Where it ought to be trading is around $1,400 an ounce. Yet we are around $1,800 an ounce now. So what's going on? What's going on is the convexity of gold that is coming to the forefront. Convexity shows that for every increase in real yields, gold is not dropping as much as it ought to have, which means investors are holding on to it because of the opportunity cost amid the war in Ukraine and amid this rout in stocks. They're saying, okay, look, gold may not return too much this year, but we'll nevertheless hold on to it rather than sell it. And that is showing up as convexity for gold.
Okay, Ven Ran from our MLive team on all things rates and, of course, the yellow metal, some sustained resilience despite the higher rates. One viewer sending a message in saying and pointing to a story about central banks, the BOE and gold trading at a rare discount, suggesting that maybe central banks are starting to sell gold. That is a story, of course, that we can unpack in future with MLive's Ven Ram. Thank you, Ven Ram, for that analysis. Let's get back to what's happening in terms of the first word news with Laura Wright. Laura.
Do you want me to leave the stairs?
Okay, the COVID pandemic may be fading into the rear-view mirror for some, but the fallout continues across supply chains and has caused crippling shortages of staff and raw materials. Transport companies like mobility giant Bolt have been among the companies affected by driver shortages. The Estonia-based company has recently announced a €150 million investment in its building out its e-scooter segment. Joining us now is Marcus Willig, CEO and founder of Bolt. Marcus, good morning. Thank you for joining us. Talk to us then about your priorities as we move out of this pandemic, the priorities for you and the team at Bolt as you try to build out your expansion plans.
Good morning, everybody. Bolt already today is the leading European mobility platform with operations across 40 countries, across multiple business lines. We operate one of the leading ride-hailing products across EMEA, one of the leading food delivery businesses, and also one of the leading e-scooter businesses. So the recent announcement we just made is that we're doubling down on micromobility, meaning all light electric vehicles, and we're making a huge 150 million further investment into that business line to expand our fleet across Europe to more than 230,000 scooters and e-bikes, which we're bringing to nearly 200 cities. Why we're doing that is because our company's mission is to replace private cars with shared and light electric mobility, because we think that's better for cities, it's better for people, and not to mention it's a massive economic opportunity for millions of drivers and couriers on the platform as well.
Marcus, your app has been described by some as a super app. You have multiple different services there: the ride-hailing, the taxi service, or the hiring service, the food delivery, the groceries delivery. Which part of that business, within that portfolio, within that super app, do you see the most potential, particularly for revenues and for growth?
We started as a ride-hailing company 8 years ago in Estonia, and that still today continues to be the largest business line in itself. However, we see the biggest potential in the coming years in terms of volume of trips and really having an impact on cities on the micromobility side. So that again is light electric scooters and electric bikes. And reasoning for that is very simple. We see that cities across Europe are going very aggressively against private car ownership. They want to reduce the number of private cars in cities due to the sheer footprint it creates in terms of parking, accidents, pollution, not to mention noise pollution and so on. And we see the best alternative there is to move to a system of shared vehicles. So again, that's shared cars, whether it's ride-hailing cars or car sharing, and of course, as much light electric vehicles as possible. And Bolt is really the company driving that trend across Europe.
Okay, so the mobility, the e-scooters, potentially the biggest driver, or at least the biggest growth area for you as things stand. How do you think about market share versus profitability? Is market share the priority over profitability at this stage in the business?
So all of the business lines we operate require a huge scale, both in terms of, first of all, to spread out the R&D costs, which are very significant, both in ride-hailing and electric scooters. But second, because actually you have very strong local network effects. The bigger operator you are in a city, the better customer value proposition you have. Because obviously when people open the app, they need to see a car or a scooter close by. So that means the barriers to entry in this space are extremely high. And what that leads to is that, first of all, you need to get the meaningful market share, and only then can you actually have a financially sustainable business. So those two things can't really be isolated. You can't have one without the other.
How do you think, when it comes to the ride-hailing business, and particularly there's that comparison with Uber, some suggest that Bolt is kind of a poor cousin to Uber when it comes to ride-hailing. What is your pushback against that characterization?
So the best thing to really compare the two is what's the pace of growth of these companies. And Bolt has been far growing faster than anybody else in the space. We're now about 3 times larger than what we were before the pandemic. Uber that you mentioned still hasn't even recovered back to their pre-COVID peaks on the mobility side. So very clearly we see that we're growing significantly faster, and there's many reasons for it. Drivers prefer us because of the better earnings. Customers prefer us because of the better prices, better quality of service. And of course, as we already discussed, the super app. So you can just use their same account for all different types of mobility. And we see that that concept is working extremely well.
Marcus, give us a sense of how challenging it is to recruit drivers now. What are you doing to recruit additional drivers and retain them? How challenging is this at this point in the business?
Extremely difficult. We're one of the largest platforms in Europe with nearly 1 million drivers on the continent driving with us actively. And we see almost in every country that given the unemployment rates are as low as they are, that's the biggest blocker to our growth. So what we're doing about it is that Bolt has always been very focused on cost efficiency. We try to operate the platform as leanly in as automated a way as absolutely can. And then we pass on those savings to the drivers so that they would make better earnings on the platform. So that's the single reason why we're able to be growing so quickly and attracting tens of thousands of drivers to us.
What impact are you seeing as a result of inflation, input costs, particularly for your scooters, but also supply chain challenges?
We see that on one hand, customers are very price sensitive when we look at the wider transportation sector. On the other hand, given that all modes of transportation are raising in price due to the fuel prices, then we can actually pass on these price increases to customers. And generally, that's not really harming any of our mobility products.
Okay, give us a sense. Are you and the team, Marcus, you were founder of this company, went back when you were just 19 years old. You must have some moonshot projects in your back pocket. Are you working on anything like taxi drones, anything that kind of, you might be looking at in the next 5 to 10 years that you can give us some color on?
On one hand, we absolutely have some very exciting products that we're looking forward to add to the platform in the coming years. Unfortunately, we need to face the reality that autonomous cars or autonomous drones, etc., are still at the time being science fiction. They're not really going to be a product you can deploy to cities at large scale in the coming years. So we're pragmatic and we're focused on what we can do to improve cities today. And again, I'm circling back to the same topic. Electric scooters, electric bikes, we see that's the best mode of transportation we can deploy to cities today.
Okay. You're valued by some estimates at about $8 billion, a little over $8 billion US dollars. Is that a fair valuation? And what are your plans for an IPO, Marcus?
Two thoughts there. First of all, we're by far the most cost-efficient mobility platform in the world. We can look at our track record of how quickly we've grown with how little capital. And second, we're also the fastest growing mobility platform in the world. So again, that combination is very unique. Fast growth and cost efficiency. And that's what the investors really value. And that's why we've been valued at the premium compared to many of our peers. Now getting to the IPO and going public, there's no urgency for us to do that, but we're ready to do that in 1 or 2 years.
Okay, you have enough runway for the next 1 to 2 years, do you?
We're very well capitalized, and again, frugality has always been at the core of the company. So we're very mindful with how we deploy that funding.
Okay, Marcus Willig, Bolt CEO and founder, thank you for talking to us about the business projections and how we are, and you and the business are readjusting post-pandemic around mobility. Okay, coming up, over a year after the retail short squeeze and its biggest victim is closing its doors. That is Melvin Capital. The plight of that hedge fund next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to The Open, and a major news story breaking earlier this morning. Sri Lanka has defaulted on its debts. That's for the first time in its history. Its failure to make payments on $12 billion worth of overseas bonds is flashing warning signs to investors that surging inflation is set to take a painful toll. Joining us now is Bloomberg South Asia economy editor Ruchi Bhatia. Ruchi, what is the latest then on the default?
Well, the situation only getting worse for Sri Lanka. The country has already stated that it is in preemptive default. They will not be able to pay their debt that is due, and they cannot do it until and unless a restructuring is done. Restructuring itself of the debt is going to take about 6 more months, and this is, of course, coming in at a time when the country has no finance minister as it begins the talks for bailout with the International Monetary Fund. In fact, its central bank governor today said that he intends to continue, even as last week he had threatened that he will resign, he will quit if there is no political stability in the country, if the political stability is not restored. And the job for the central bank governor is not going to be an easy one, given the fact that we are seeing a runaway inflation in the country. In fact, it is possible that from a 30% level, inflation will rise to 40% in the next reading. Besides that, the country is reporting shortages across the board, from food to fuel, essential supplies, gasoline. The country has no dollars to pay. Its forex reserves are dwindling. In fact, they hardly have any money at the moment, and this is certainly going to make life difficult for the policymakers after the resignation of the former Prime Minister Mahinda Rajapaksa. There is a new man at the helm, but remember, he still needs a team, because many of the opposition leaders are already refusing to join the cabinet, and as I said, this is only going to worsen troubles for the country going forward.
Okay, great update there from Ruchi Bhatia there, our South Asia economy editor, on the situation unfolding in Sri Lanka. To what extent is it a canary in the coal mine for emerging markets, and how much of this is in fact idiosyncratic to Sri Lanka itself is a story that no doubt we will be picking through in the days and weeks ahead. Let's get back to a big story in the hedge fund space, a remarkable story. More than a year after Gabe Plotkin's Melvin Capital Management was hit with a short squeeze. Remember that one, the famous short squeeze by amateur traders who organized on Reddit? The $7.8 billion hedge fund is giving up and shutting down. Join us now with more on this and some of today's other big finance stories is Bloomberg's the one and only Charlie Wells. Charlie, how did things go so wrong then for Melvin? Was it all the short squeeze?
You know, it really wasn't. It does kind of start there, right? Because Gabe Plotkin had such a sterling reputation in the hedge fund space. He cut his teeth at SAC Capital Advisors, started his own firm in 2014, was delivering 30% returns, but of course last year that dwindled down to a loss of 39%. He was able to stem some of the losses from that infamous short squeeze, but it just wasn't enough, particularly over the past few months when markets have really been struggling, particularly the consumer and tech stocks that the fund had really been investing in.
I mean, we're talking about canary in the coal mines when it comes to emerging markets in Sri Lanka. What about the hedge fund space then? Is this one and done, or are there more Melvin Capitals under the woodwork?
Yeah, Tom, that's a concern on Wall Street. So for a long time in this environment, there had been concerns that some hedge funds could potentially be on life support. Well, we got a fatality.
We got a fatality indeed. And it was the bets as well. They seemed to be coming out of it towards the end of last year. You said they had an injection of capital. But then the bad bets, again, on some of these tech sector names.
Yes.
Where does that leave the way that people are thinking about how you hedge within this environment?
It's difficult. So when you look under the Melvin hood, you saw in the first quarter, 5 of the 6 largest holdings at the end of the first quarter were actually down double digits this past month. So that speaks to the trouble that a lot of these equity-focused hedge funds have been having. And we've seen other hedge funds following different strategies fare a little bit less bad, or actually, you know, have some profit. So multi-strategy, macro strategies, those have been doing better.
And any victory laps from the Reddit crowd?
You know, it's sort of a lose-lose story here, right? Because, you know, a year ago, if this had happened, I feel like those Redditors would be celebrating. They were, you know, celebrating their own returns. Over this past year, they've been struggling. So it's a lose-lose situation.
A lose-lose situation. What a positive note to end things on. That's unusual for you, Charlie Wells. So uplifting, usually. Charlie, thank you for that take on all things Melvin Capital, what it means for the hedge fund industry, retail investors as well. Let's check in on the markets. Another extraordinary day when it comes to the sell-off. Down 1.7% across the benchmark European stocks following that rout that we saw yesterday on Wall Street. Just a reminder, the Nasdaq fell more than 5%. In terms of the futures then, stateside, the S&P evening's down 0.9%. And the Nasdaq futures down 1.2%. There is still a move into safe havens around the Treasury space. Yields down on the US 10-year by almost 4 basis points. That it is it for the European market open. Surveillance early edition is up next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
As inflation comes down, hopefully some of those prices will revert and they'll come down. Food prices often, can round trip, and energy prices too. But gas prices are high, and that's always, a negative thing for consumer confidence.
Going forward, if there are no significant changes in the data in the coming weeks, I expect 2 additional 50 basis point rate hikes in June and July.
Russia's war against Ukraine has exacerbated the issue of food security for people around the world, particularly in emerging and developing countries.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua in New York today, and here's what's coming up on today's program. Market rout. U.S. stocks suffer their worst sell-off in almost 2 years as growth fears pummel sentiment. European stocks also slide at the open. Supply chain shock, a warning from Cisco, and inflation pain for retail hammer sentiment, and growth warnings abound. Well, JP Morgan is the latest bank to slash its forecast for the U.S. as Standard Chartered downgrades China. Now, a lot of the story, of course, is playing out on the market. So onto the markets, and after the S&P yesterday and that huge fall, one of the biggest and ugliest days we've had in the last couple of years, we look towards sentiment in Europe. Now, European stocks are also sliding again. It's really the concern about higher inflation cutting into corporate performance, overshadowing some of the bargain hunting of beaten down stocks that we saw in the last couple of days. European stock 600 down some 1.6%. Technology again getting slammed. And I guess it's the bets of these robust earnings that could have helped investors weather the turbulence, and that is now thrown into doubt after U.S. consumer tightens signal growing impact of high inflation on margins, but also on consumer spending. Now, if we break down the European map to see exactly the countries that are doing better and the ones that are doing worse, quite a lot of red on the screen. There's not a huge difference whether you're sitting on the FTSE or whether you're sitting over in the DAX. Again, it's energy, it's inflation, but it's really markets trying to price in some kind of growth scare. The question of the day is, without a doubt, where's the bottom from the S&P 500? That's a question we'll be asking all of our guests. Now, European stocks sliding, pointing to more pain ahead following the biggest drop on Wall Street in nearly 2 years. Earnings report, as I was saying, from retail titans, Walmart, Target, increasing concern that some of this higher inflation will start biting when it comes to consumer spending.
We are playing it more conservatively than more aggressively, both on the fixed income as well as on the equity. So to your point, dialing down areas that are high yield or areas like that.
It's a different phase of investing. It takes different approaches. Your best approach is actually to de-risk portfolios at least back to neutral to some degree.
I think today is a little bit more validation that the consumer is not as strong as we thought it was, that we're starting to see inflationary pressures really affect the earnings of companies.
The consumer is getting weaker from the bottom level up, so from the lowest income up, and it remains to be seen where that stops.
Let's get into the key market drivers with our markets live editor, Noor Ali. Noor, so great to see you. First of all, I mean, was it pretty naive to think that you could have inflation at 6, 7, 8%, and actually the consumer doesn't feel anything?
That's a little bit difficult, right? Because last year, Francine, you and I sat on this stage and we talked about how these costs will carry through to the consumer ultimately. And, you know, we were all in contractual obligations. We were saying, no, it's okay for that year. But we knew it's going to extend, and we knew that it was going to hit these companies ultimately, so much so that they'll pass along these costs to the consumer. And that makes inflation a lot stickier because it's a lot harder to change prices now that we're still into this tightening cycle. We haven't even started yet, and these prices are starting to trickle down even more.
Noor, I'm looking at the sectors, and actually a lot of them are getting slammed, but it's really the consumer goods that I think are losing the most in Europe, around some 3% lower.
Yeah, absolutely. And even energy, you know, you would assume that maybe energy could be a shelter this morning. It isn't. We're definitely struggling. We're in a very classic risk-off situation. You do see some havens. The bonds are doing very well. The Swiss franc, the Japanese yen, they're performing much better, but surprisingly not the dollar because, I mean, a lot of the people are telling you now, perhaps we've topped out in the bottom and now we've topped out in the dollar, and we're going to start seeing some struggle ahead for that.
So, Noor, I mean, we need to talk about the dollar. I mean, the dollar rally really hurts so many asset classes. Does it actually give us an indication of where money is pouring into, where it's rotating to?
Well, look, I mean, the very interesting thing what's happening in the dollar right now is that it's been the haven choice for the last year because everyone's been saying, okay, we're going to take cover now in the dollar. So you did see a lot of struggle, even bonds and other haven currencies like the Swiss franc and the Japanese yen were underperforming relative to it. This morning, all G10 effects are up against the dollar at a time where you would assume the dollar would pick up and carry through. That's because you've seen some decoupling across with yields. So if you see a correlational study with the dollar against 2-year yields and the Treasuries front, you'll see that they've really parted ways there. So I'm anticipating some trouble ahead for the dollar.
Noor, with all of these great graphics, where have you been all my life? Noor is bringing like her A game in terms of like 2 standard deviations in some of these markets. What does it mean going forward, Noor? I mean, when do we know when we've hit bottom? How difficult is that to call?
So it's a little bit difficult because we still haven't started the tightening cycle officially with the Fed. We have raised rates, sure, but we're still a long way ahead. I think it's going to be a troubling summer. So I'm about to book my holidays now just to make sure that I'm here for a very busy summer. I think the bottom is still a ways ahead for sure.
Okay, you and we take the show to Amalfi, so that can be our holiday, but we're still on Stocks Watch. Our Bloomberg MLive editor. You like the sound of that, Noor? I'd say yes, right? Noor Ali. Now, let's also look at what Cisco shares are doing. So this is pre-trade, but actually they're falling some 14% in U.S. pre-market trading. This is after they cut their forecast, and it's really very clear that Cisco spooked investors with a warning that Chinese lockdowns and other supply disruptions would wipe out sales growth in the current quarter. That's renewing broader concerns about tech spending in a pretty shaky economy, and that share price pre-market down 14%. Now, Treasury Secretary Janet Yellen has confirmed it's unlikely that the U.S. will extend an exemption that allowed Russia to make bond payments to U.S. investors. Speaking ahead of a gathering of G7 finance ministers, Yellen said the U.S. and its allies and partners share the goal of reducing Russia's revenues in the wake of its invasion of Ukraine.
The sanctions imposed against the Russian Federation have already had enormous impact. Russia's experiencing recession, high inflation, acute challenges in their financial system, and an inability to procure the material and products they need to support their war or their economy.
Now, for more, we're joined by Bloomberg Europe economy reporter Alessandra Migliaccio, who's at the G7 finance meeting in Bonn, Germany. Alessandra, good morning. So what exactly is on the G7 agenda?
Good morning, Francine. Good morning to everyone. There are many things on the agenda. Obviously, Russia, Ukraine is the main topic this morning. It's going to be the main topic for the beginning of the meetings here in Bonn. What to do, how to help Ukraine immediately, the practical aspects, and of course, sanctions. Are they working? How much they're working? What to do next. There are other things, however, on the agenda. The meeting continues tomorrow. The world economy, of course, concerns about inflation, especially with the impact from the war in Ukraine, Russia's invasion, and what it's done to energy prices. Monetary policy is, again, an issue because, of course, here we don't have just the finance ministers, we have the central bankers, and monetary policies are different among countries. So all of that on the agenda, and very quickly, climate as well, and tax policy as well.
So will they reach an agreement for, to give Ukraine more aid?
Yes, they're relatively confident on that as immediate aid. I mean, everyone is pitching in. The U.S. just passed a package that's worth $40 billion. It's different things. Europe is pitching in. Each single country is giving aid. You have the EBRD. But what they're talking about today is immediate aid. Ukraine has estimated their finance ministry that they need about $5 billion a month. So they will try to give the initial $5 billion and then go on for another 3 months at least. So that should be about $15 billion. And then we'll see, obviously, what happens next.
Alessandra, thank you so much. Alessandra Migliaccio there in Bonn, Germany for us at the G7. Now, coming up, we'll have much more analysis of the latest market sell-off and what it means for central bank policy. We'll be joined by Salman Ahmed from Fidelity International. It's going to be a robust conversation on, of course, the sell-off in markets. This is Bloomberg.
Stories about what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in New York. Now, risk-off sentiment continuing to spread through the market. Stocks cannot catch a break as earnings report from U.S. consumer titans like Walmart and Target stoke inflation concern. We also checked on Cisco pre-market down 14% after it cut its forecast. Now, we're joined to talk about the markets, to talk about the way forward by Salman Ahmed. He is Global Head of Macro and Strategic Asset Allocation at Fidelity International. Salman, as always, thank you so much for joining us. First of all, should we have expected this kind of consumer reaction? If inflation is so high, it's very unlikely that the U.S. consumer can stay strong.
Good morning, Francine. Certainly, I think the fact that inflation has been now strong for a while now, this is where the pressure is starting to build. I think there was this thesis that the excess saving buffer, which was built up as a result of the COVID fiscal packages, and the fact that people were not able to spend as much because of the lockdowns, will create some kind of protection against this high inflation. But the fact is that when you have inflation at 7-8%, the real purchasing power is falling quite sharply. And this is not a 1%, 2% inflation world. And that's where we are seeing the pressure come through on the consumer, given that the basket, which is really under pressure in terms of price rises, is the one which is being consumed.
So, Salman, what does it mean actually for some of your calls? I know I think you're still overweight U.S. equities. Where's the bottom for the S&P 500 at this point?
So overall, we are cautious. So our equity block, if you will, is underweight. So within that equity block, we have a preference for U.S. equities, especially on the value side of things. And we are underweight, for example, Europe and other regions. So it's a more of a nuanced view. And we are very negative on credit as well. Now, the question for us, as you rightly pointed out, is where is the bottom? So on average, in a recession type pricing, you would expect equity markets to go down between 25 to 30%. If there's a balance sheet type of crisis, then you can have much bigger sell-offs. So we think that the balance sheet, especially on the corporate side and the banking side, are in better shape. So we are getting into that territory where we have proper kind of recessionary pricing coming through, and this switch between bond prices, bond yields, and equity is a very important factor to watch going forward.
Salman, what kind of recession are you predicting? So if we're starting to price in a recession, it's different if you look at the 2007-2008 recession or if you go back to the 1990s.
So we are thinking about more of a version of 1980s, where you have real business cycle-based shocks. So the balance sheet protection or the strength which has come through on the banking side, we would expect that the shock will not be multiplied, and the central banks will be able to take care of any liquidity issues which may come through. So this becomes a much more of a natural slowdown as a result of inflation, as a result of the hawkishness from Fed's policy. So it's much more 1980s type template rather than the 2007 to 2008 template, which is a more balance sheet driven recessions.
Salman, overall, what happens if we're in a stagflationary environment? I mean, are we definitely going to see stagflation? And is there anything that policymakers can do to get out of it? Or are we going to be in a Japan-style 10 years of stagflation where no matter what you try and do, we see this kind of like really uneasy tension?
So I think stagflation for the US on a sustained basis is not a given. Of course, the Fed is talking very hawkish. If you look at the financial conditions index, it has pumped through a sizable amount of tightening, so more than 200 basis points. Despite the fact that the Fed is only starting to do actual actions, their narrative has been quite hawkish and the markets have responded. So there is quite a bit of tightening in the pipeline, and we are expecting that growth will slow down and take some of that heat out of the system, which will start to normalize inflation. But ultimately, it will depend on the Fed. If Fed wants to kill inflation, it can. The question would be at what price?
Salman, thanks so much. Salman Ahmed there from Fidelity International. He stays with us. We'll also talk about King Dollar, or certainly the dollar rally. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Sri Lanka has gone into default for the first time in its history as the government struggles to halt an economic meltdown. The country's central bank chief says policymakers had told creditors the nation wouldn't be able to make payments until debt is restructured and is therefore in preemptive default. Soaring inflation has prompted massive protests and a political crisis in the country. Now, the U.S. Senate has confirmed Bridget Brink as the next ambassador to Ukraine, a move that comes after the country's embassy in Kyiv was reopened following a 3-month hiatus. Finland and Sweden, meanwhile, have formally handed in their NATO applications. However, Turkish President Recep Tayyip Erdogan has made clear he'll block the accession process over the Nordic nation's policy towards Kurdish groups that he does consider as terrorists. Closer to home, the UK Chancellor is warning that extra government spending to help ease cost of living pressures risks stoking even higher inflation. Rishi Sunak told business leaders there are tough months ahead for the country's economy.
At the same time, we need to be careful. As Tony rightly warned us this week, at a time of severe supply restrictions, an unconstrained fiscal stimulus does risk making the problem worse.
Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, coming up, stocks and futures swoon, bonds rally. I mean, more than swoon, they kind of sell off aggressively. We continue our conversation on the market turbulence next. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in New York. Now, the market's falling out of bed following really some of the pressure that we saw in the S&P 500 yesterday. Yesterday was the ugliest day for American stocks in the last 2 years. The stock rout is deepening. Economic concerns are piling up. It's not only about the U.S. consumer, but of course, the idea that policymakers are really running out of tools to deal with this inflationary pressure. So European shares are tumbling. And again, if you look at U.S. futures, they're also signaling more losses ahead. Growing concern that high inflation is cutting into corporate performance. Still with us, Salman Ahmed from Fidelity International. Salman, I'm looking at some of these stocks. I mean, it's just ugly, ugly, ugly. Are there sectors, when do we know when some of the sectors actually hit a bottom? Or are there sectors where you still see value in Europe?
So on the European side, I think we are still focused on the healthcare sector, for example, which we think has defensive qualities, and there are some structural themes as well. Within some certain themes we think are starting to take shape. For example, cybersecurity. That's another theme we are focused on. It has come under a lot of pressure, but there is a structural shift towards a bigger demand for cybersecurity. So we are looking at some specific longer-term themes which may become come at a cheaper price, if you will, as the dust settles. And another one I can add to the lot is renewables, because as the energy security policies change in Europe, the push towards a longer-term move towards renewable will also increase. So there are opportunities arising, but of course, as you rightly mentioned, the short-term volatility and the pressure is an extreme one right now.
So, I mean, given, we had some pretty robust earnings and we thought that some companies or sectors were safe, that doesn't seem to be the case. Are we going to see a lot of volatility in the next couple of quarters until things settle, or you think it'll be a shorter-lived volatility bout?
So we are looking at two factors. The first one is the proverbial Fed put, how close we get to that Fed put. I think equity markets pressure itself does not take us closer to that Fed put in this cycle because inflation is so high. So we are looking at credit markets. They are starting to come under pressure. We think that pressure will continue to build up. And that's where we have to watch in terms of how closer we get to the point where the Fed says that enough is enough and there's enough road damage in the pipeline to bring inflation down. So that's factor number one. And the number two is valuations themselves. But the fact is that in the US, we are back to the median of the last 5 to 10 years. So we are not in screamingly cheap territory yet.
But Salman, on that Fed put, and again, I had a conversation with Mohammed El-Arian saying there's no Fed put anymore given where we are in inflation. Is there a certain level on the S&P where you think that kicks in, even if it's not this year?
I think our thinking is this is a more of a multi-dimensional Fed put, and we will be looking at credit markets rather than equity markets. So I do agree with him that probably this is not going to be geared towards some stocks coming down. But if credit markets come under pressure, there is sizable tightening further in financial conditions. The Fed will have to take notice because ultimately, as things stand right now, they don't want a recession to bring inflation down. If it happens, it will be an accidental one. But that's where we are watching. This is the credit markets, and that we think will get us closer to the Fed put, not the equity market pressure on its own.
Salman, what do you do with currencies right now? So I was going to ask you about King Dollar and the dollar rally. I'm looking today, though, at haven currencies. I'm looking at yen, I'm looking at Swissy. I mean, they're seeing a bit of a bid. Is that a bit of a relief for some of the emerging markets? If we have an environment, we have inflation, maybe policy mistakes, and a higher dollar, there's a lot of countries, especially in the EM space, are going to be in a lot of trouble.
I totally agree with you, Francine. This is a very toxic mix. If you are a commodity importer, on top of that, you have dollar going up. And of course, if your creditworthiness is also on the weak side. So we already are seeing examples of what's happening in Sri Lanka. There are other frontier economies which are also starting to feel the pressure. So some respite on dollar would be good for the global environment. But so far, what we have seen is that dollar has moved in line with interest rate differentials. So the Fed hawkishness, which has been quite fast and aggressive compared to other central banks, has helped the dollar. But remains to be seen how it pans out going forward.
Salman, thank you so much. Salman Ahmed there, Global Head of Macro and Strategic Asset Allocation at Fidelity International. Coming up, we'll have plenty more, of course, on these markets. If you look at the risk of economic slowdown, elevated inflation, and then these hawkish central banks, strategists are so cautious about what's coming up. We also talk cryptocurrency with PGIM's COO Taimur Hayat. This is Bloomberg.
Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Market rout, U.S. stocks suffer their worst sell-off in almost 2 years as growth fears pummel sentiment, while European stocks slide at the open. Supply chain shock, a warning from Cisco, and inflation pain for retail actually hammer sentiment. Growth warnings abound, while J.P. Morgan is the latest bank to slash its forecast for the U.S. as Standard Chartered downgrades China. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua in New York today. Now, the markets just keep on getting slammed, and so we need to start the markets and trying to find a bottom for the S&P 500. I urge everyone who's a subscriber to the MLive blog to go and check it out. They have some really amazing things in terms of what it means for the markets going forward as we had this massive slump for personal care. Again, this is because of concerns about margin as inflation starts to bite. In FX, haven currencies such as the Swiss franc and yen are rising, the dollar declining, all G10 FX rising against the dollar, while the franc and Norwegian krona were the strongest among some of the peers. And then you see technology getting hammered over in Europe, with the European stock 600 down 1.7%. Now, I'm in New York because later today we'll also be speaking to Ken Griffin, the chief executive of Citadel, at the Bloomberg Intelligence Market Structure Conference. I know he'll have a thing or two to say about markets and volatility, so be sure not to miss that interview. Now, PGIM, the $1.5 trillion asset manager, is negative on crypto from an institutional investment perspective. Timur Hayat, the COO, sees little real-world evidence that cryptocurrencies deliver diversification and that they're effective inflation hedges or even possess the characteristics of a safe haven asset. Well, PGIM COO Timur Hayat joins us now. Timur, as always, thank you so much for joining us. I can't believe I'm in New York when you're in London, but that's another matter. Talk to me about cryptocurrencies. I mean, what kind of role are they playing in these crazy markets where we're seeing a massive sell-off and so much volatility?
Well, I think they've actually confirmed lots of the things we've said about cryptocurrencies. You know, Bitcoin is a teenager this year. First trade happened in 2009. And they've proven that many of the things that we thought cryptocurrencies might do for us actually still don't play out. Do they work as sort of digital gold? They haven't been a safe haven asset. Do they work to protect us against inflation, Francine? Well, inflation's gone to 9% in the UK where I am today, and you know, Bitcoin and the other cryptocurrencies are heading in the other direction. Do they have any stable correlations to act as a diversifier versus other asset classes that investors are in? There's absolutely a lack of stability, and I think that's proven even more so now, where they're basically acting as a sort of levered risk-on trade rather than a true diversifier of the portfolio. No. So I think that's just the beginning of the trouble for cryptocurrencies, because we still have the headwinds of regulation and central bank digital currencies, which will be quite negative for currencies in the future as well.
Timur, I love your straight talking. Tell me what you really feel on cryptocurrencies. But do they serve any purpose? Like, the markets are falling out of bed, and you know, compared to some of the other parts of the markets, is there an argument that says cryptocurrencies in the future will morph into something that could be used as a broader asset class?
Well, we never say never at PGIM. We look at what the data says. We've tried to torture the last 12 years of data on Bitcoin, and at the moment, there's no evidence of stable correlations, diversification, a real risk-return benefit that outweighs the drawdowns. But there are real opportunities, Francine, in the broader ecosystem, the sort of accidental innovation that happened in the creation of cryptocurrencies, blockchains, distributed ledgers. We actually see 4 or 5 pretty important investment opportunities that we do think long-term investors should focus on.
So, Timur, where do you see actually the value longer term for some of these things? I guess some of the non-crypto believers say the concern is that it's getting such sway in retail parts of the markets that it's just impossible to ignore because a lot of clients want to know how they can get, in on the action.
I think on the cryptocurrency side, it's important for institutional investors, long-term investors, to avoid the FOMO, to avoid the momentum trade. It's fine as a retail investor if you want to speculate in this for a small piece of your assets, just like you might gamble on other things. But for long-term institutional investors, Francine, the real opportunities are in the broader blockchain universe, not in the gold, but in the sort of shovels and picks. And that's in smart contracts. It's in private permissioned blockchains used by financial services company. It's in tokenization. It's in the infrastructure that central bank digital currencies will need to use that sort of underpins cryptocurrencies. And I think it's maybe just watching the metaverse space where there's a lot of losers, but maybe a couple of winners in the future too.
Timur, I love that. Avoid the FOMO could actually apply. Wise words could apply to so many things in life. Timur, give me a sense of actually where you see this market volatility and the market sell in the broader markets. Like, where do we find a floor on the S&P 500?
Yeah, I think, and we firmly believe, Francine, that we haven't seen the bottom of the dip yet, that this is just the beginning of a roller coaster ride. Everything is now driven by inflation. Central banks want to retain their credibility on inflation. And I think as that inflation journey spills over into monetary policy, fiscal policy, markets, there's room to go. And our fear is absolutely inflation is quite structural and embedded now. It's in housing, it's in other things that takes a long while to play out. But we also worry about, and I would think investors should be thinking about recession risk. Yeah. If central banks want to retain their credibility, they may go too far, too fast, and we may be in a recession already exacerbated by the war in Ukraine and other factors. So recession risk weighs on us quite a lot.
But Timur, is a recession now unavoidable? So we're seeing, I have, James from the news desk just sent me a story about chicken wings in the U.S. Pre-COVID, they used to go for $19. Now they're going for $34. Is this symptomatic of inflation that's out of control that leads to stagflation with monetary policy not being able to avoid a recession?
I think we'll all still hope, Francine, that somehow the central banks can engineer a soft landing and just kind of, create the Goldilocks level of rate rises to protect inflation, but not send the economy into a deeper spiral downwards. And let's remember the US is in a much stronger place in terms of unemployment and growth than Europe or other Asian and emerging market economies. But I do think our base case is that given how late central banks have acted on inflation, how embedded expectations might become, that a recession is quite likely in the next 24 to 36 months.
So what's your haven par excellence, if there is one? It's unclear exactly what form that takes.
A safe haven right now?
Yeah.
We see a lot of our clients, certainly across PGIM, across our 1.5 trillion in assets sitting in cash. I think the best strategy right now is to be fairly risk-off, be in the more conservative part of various asset classes, and wait to see a very volatile journey play out.
Timur, if there's so much inflation and so much margin pressures in the U.S., how much worse is it going to get for the rest of the world?
I think Europe has the added pressure of the Ukraine war and energy prices and commodity prices that perhaps the U.S. is a little more immune to on the energy side. Mm-hmm. So I think there's going to be a fair amount of embedded inflation in many countries, and you're already seeing waves of this hit emerging markets. The global economy, despite all the talk of delinking, is still very interconnected, and we are seeing these inflation waves spiral into emerging markets as well. So I think this roller coaster ride has some space still to run, and I do think that we will have inflation as the central tenet of our markets move around the world for the rest of this year and much of next.
Timur, thank you so much for a great conversation. I mean, I know we plan most of our shows, but it's so good. We got lucky with you today coming on TV to talk about this market sell-off. Timur Hayat there, COO at PGIM. Now, coming up, imagine a world where autonomous cars take us to work, pick up our kids, and bring us groceries. Is that utopia or is it reality? That's the vision of a London-based company, Wave. We'll be joined by the chief executive, Alex Kendall, to discuss why the company is partnering with Microsoft. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in New York. The market's still falling out of bed. Yesterday, we had the ugliest S&P 500 day in about 2 years. The stock rout also deepening in Europe. Again, it's all about the concerns on the economy, and those concerns are, of course, piling up. Now, if you look at U.S. futures, they're also signaling more losses ahead amid this growing concern that high inflation is cutting into corporate performance. So we used to have some robust earnings bets, and that we thought would have helped investors weather the turbulence. But really yesterday, U.S. consumer titans signaled growing impact of higher inflation on margins, consumer spending, and that's really the bottom line of why some of these markets are freaking out. Now let's get straight to the Bloomberg Business Flash. She never freaks out. She's Leanne Garrett. Hi, Leanne.
I was just about to say, you never freak out, Francine. Hi, and we miss you here in London. Now, EasyJet has reported a surge in summer bookings, but says there's still too much uncertainty over demand to provide an outlook for the fiscal year ending in September. The British budget airline says sales over the past 10 weeks are running 6% ahead of 2019 levels.
There's a huge pent-up demand for the summer, so we're seeing that in the bookings, and we expect to fly close to 2019 levels of capacity in our Q4, July, August, September. And the run rate of the bookings that we've seen for the last 10 weeks, to give you an example, is way over and above what it was at the same point in time in 2019. So I don't think that there's so much concern really for this summer as such because of that pent-up demand. It's more about what this will mean going into next winter and beyond that.
Now, Target shares plunged the most in 35 years after it cut profit forecasts due to soaring inflation. The U.S. retailer's CEO says surging costs show little sign of easing. Operating profit is expected to come in at only 6% of its sales this year, 2 percentage points below the previous forecast. This a day after Walmart stock plunged on disappointing numbers. Bloomberg has learned the EU's top regulator has concluded global banks haven't moved enough senior staff from London into the European Union after the country split from the bloc. An exercise by the ECB known as desk mapping has found that several big lenders haven't built up sufficient local capabilities in the region. Reluctance among senior executives to leave London is understood to be one of the key problems. Cisco shares tumbled as much as 19% in late trading after it warned of a sales decline in the current quarter. The U.S. maker of networking equipment blamed disruptions stemming from lockdowns in China and the war in Ukraine. The company had forecast sales growth of 6% this quarter, but now says revenue will instead fall by as much as 5.5%. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, Wayve, W-A-Y-V-E, the London-based autonomous vehicles company, is partnering with Microsoft to leverage the supercomputing infrastructure needed to support the development of self-driving cars. Now, since it was founded in 2017, Wayve has raised $258 million from backers such as Ocado and Sir Richard Branson. Now, through the use of machine learning, Wayve says it's eventually aiming to deploy autonomous vehicles in 100 countries. Now, we're now joined by Wayve CEO and co-founder Alex Kendall. Alex, first of all, talk to me about this utopia world where there's an autonomous car that, picks up my kids, brings them to school, drives me around whilst I can do my Zoom calls. Like, how far away are we from that?
Look, it's the future. I think autonomous driving is going to, it's going to be the first step in moving us forward as a society into the age of autonomy. And I think what's interesting about autonomous driving is it's going to be a really widespread application of embodied intelligence. And that's what we're really excited to be building at Wayve. Embodied intelligence is taking artificial intelligence out into the real world and building systems that have the intelligence to interact with us at a really large scale. We're talking about autonomous vehicles making their own decisions, driving around our cities, and ultimately letting us move people and goods in a more effective way.
Alex, that's also what scares people, right? It's basically the question if you're in a car and there's a child or like someone else crossing a road, like what decision do you take if you have to swerve? How concerned are you that regulation, and of course the fact that this needs to be safe, will delay it by decades?
I think we're really excited and encouraged to see what's happening on the regulatory front. So the UK government announced last week in the Queen's speech that this is something they're going to be legislating for in this upcoming parliamentary agenda. But I think more importantly, it is going to be disruptive. It's going to completely change how we move around. But I think the benefits are unparalleled, and that's something that we really need to lean into. If you think about the economic benefits, more importantly, the safety, and most importantly as well, the sustainability you're going to get from autonomy, that's what we're really excited to unlock.
So, Alex, who's your biggest rival right now? And I guess when you talk about autonomous cars, is the big winner the people that create the software, or is it the ones that will actually make the end product, the cars?
A lot of people think it's about building cars and automotive technology, but actually it is fundamentally a technology problem that's stopping us today deploying autonomous driving at scale. I think this has been a sector that you often can relate it to being a space race of our generation, because it's a multi-decade generational problem to solve. And we've seen some fantastic efforts, really pioneer this space, particularly from North America. But fundamentally at Wayve, we're taking a different approach. And we see that this approach using machine learning to scale the technology is really what's going to let us deploy this in over 100 cities.
But so, it'll make a difference if you partner further down the line with Tesla to a Volkswagen. Like, how do you think about partnering in the future?
We see our technology as being a very adaptable autonomous driver. So we can deploy a driver as a service to commercial fleets. And the commercial fleets we work with, so today we partner with DPD, Ocado Group, and Asda, three of the UK's largest and most technology advanced fleets. Mm-hmm. And we see all of our fleet customers having very different requirements for the actual vehicle they need to operate. And so what we're building is a really adaptable driver that can give them the mobility services they need to make their services most effective.
So Alex, give me a date. When am I going to be like sitting in my car like this, just like reading and, you know, like this, speaking to my producer about what's coming up on the show instead of having to do any of the driving?
Look, this is a really hard and challenging problem, and I think the industry has been plagued by false hype and expectations. When we started the company in 2017, we were told from big tech this was just going to be a year away, and I think that we're discovering this is a really challenging task, but I think with a lot of what we're seeing today, a lot of the ingredients are coming together from regulation, technology, public acceptance, and the commercial environment to make this possible. So we're going to see this technology really come to age this decade, but I'm hesitant to give a specific timeline around this. We're working on it as hard as we can.
Okay, Alex, come back in 6 months and then we'll have an update. I need a date for when my life gets a lot easier. Alex Kendall there, Wave Chief Executive Officer and co-founder, joining us today. In the meantime, the markets, especially in Europe, still going through this rout. We saw it yesterday with the U.S. indices. U.S. futures today still pointing to more losses ahead amid this growing concern that high inflation is cutting into corporate performance. Now, this is a picture across the board. When you look at all of the industries that make up the Stocks Europe 600, they're all on the downside. Coming up, over a year after the retail short squeeze, and its biggest victim is closing its doors. More on Melvin Capital next. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix in New York. The market's really falling out of bed. I'm seeing quite a lot of chatter that actually there's going to be a lot of companies and a lot of banks having to lower their forecasts, not only for the economy, but certainly get inflation forecasts up. Now, the rout that erased $1.5 trillion, think about that, of market value from U.S. equities yesterday seems to be deepening today. European shares tumbling, U.S. futures signaling more losses ahead. There's more and more growing concern that higher inflation is cutting into corporate performance. Now, more than a year after Gabe Plotkin's Melvin Capital Management was hit by a short squeeze by amateur traders who organized on Reddit, the $7.8 billion hedge fund is giving up and now shutting down. Well, joining us now with the very latest and some of today's other big finance story is Bloomberg's Charlie Wells. Charlie, good morning to you. So how did things go so wrong for the fund that now they just have to close shop?
You know, Francine, there's a saying that the first cut is the deepest, and I think that really was the case with Melvin Capital. So we go back to a strange time called January 2021. We see that short squeeze, and the fund was down 55% that month. They managed to recoup some of those losses over the course of last year, ending the year down 39%. But these past few months with markets in such bad shape seem to have proved just too difficult for the fund to recover from.
So if you look at what that means for other places in the space, are there places, Charlie, where we should worry that the same thing could happen going forward?
Yeah, so the street has been very concerned about the health of hedge funds, particularly over these past few months, particularly equities hedge funds. We've talked about how that strategy has just not been paying off over the past few months. You look at Melvin Capital's book, you see in that first quarter, 5 of their 6 largest holdings were down, at the end of quarter one, were down double digits this past month, and that 6th was down 8%. So that equity strategy was just so risky and just seemed to not pay off here. That's the concern that it could be a larger problem across the space.
Charlie, we've had a news, of course, on probe into private messaging in banking. What are the details and how damaging is that?
Oh, yeah. So this is another concern hanging over not just funds, but also banks. So it's Deutsche Bank's annual general meeting going on today. They have concerns about private messaging on platforms such as WhatsApp. So over the course of lockdowns, bankers and other traders use platforms like WhatsApp. And the concern by regulators on both sides of the Atlantic is that business activity was conducted over these platforms. Hanging over the industry is a $200 million fine that U.S. authorities levied on JP Morgan, and a lot of other banks are worried about that, conducting internal investigations and saying as well that they're cooperating with U.S. regulators who are expanding a probe.
Yeah, so Charlie, I thought actually WhatsApp had been banned by so many banks. Just go back to the IB guys on the Bloomberg terminal. That's compliance, right?
I think that's a good idea. And what's really interesting is we're seeing some banks roll out new technology to actually allow their staff to continue to use some of these platforms. And that differs from a few years ago. Say 5 years ago, Deutsche Bank banned WhatsApp, but now they're trying to figure out how to use it in a compliant way. But you know, IB could be a good solution there.
There you go. Thank you so much. Our Charlie Wells there with the very latest on some of the banking. And actually, it's really, really hard to get all of your staff on one messaging group that's good for compliance, especially when WhatsApp is just so popular. Back to the markets because they're falling out of bed. Yesterday, we had a huge, huge sell-off. $1.5 trillion in terms of valuation being wiped off. The ugliest day for the S&P 500 in 2 years. And there's no real sign of the bottom or of us hitting bottom right now. The European stock 600 down some 1.7%. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, K-Line's here in New York, and Edwards is in London. They have much more on the Bloomberg market route, so they have much more on the dollar. We see a demand for havens, currency havens, such as Swissy, but also yen. This is Bloomberg.
estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Next year is really the difficult year, but it could come again. There are things that can make it come forward.
You're seeing the earnings misses are starting to come in.
We actually find ourselves in a pretty defining moment now.
It's going to be a rocky road.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Thursday, May 19th. Our top stories today. No end to the sell-off after that $1.5 trillion meltdown. U.S. futures signal it will be another tough day for those holding stocks. European stocks are also in the red. Calling it quits, Gabe Plotkin is shutting down his Melvin Capital hedge fund more than a year after it was hammered by amateur traders in a short squeeze. And a warning from Beijing. China tells the US its increased support for Taiwan will lead to a dangerous situation. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta and Kaylee Lines in New York. Matt Miller is off today. Well, Kaylee, after yesterday down more than 4% on the S&P and the Nasdaq, it's gone around the globe and it continues here in Europe and into US futures.
And it continued in Asia as well. You really saw equities there following on the losses we saw in the US yesterday. The pain just isn't stopping. The MSCI Asia Pacific Index falling about 2% overall overnight. That was a loss led by Hong Kong, which was a loss led by technology specifically. The Hang Seng Tech Index down about 4%. A lot of that had to do with one stock in particular, which is Tencent. Of course, it reported its earnings after the close of Asian trading on Wednesday. Its slowest revenue growth since 2004. Plus, executives of the company said that let up on the Chinese regulatory crackdown isn't going to happen in a fast fashion. It's going to be a slow process. So that is hanging on sentiment more broadly and hung, of course, on Tencent stock, which was down about 6.5%. The other story we are continuing to follow in Asia is the situation in Sri Lanka. Inflation there, of course, accelerating rapidly, could surge to 40% in the coming months, according to the country itself. And now the country has fallen into default for the first time in its history after it missed making the payment during the grace period on $78 million worth of coupon payments. So you're definitely seeing that ripple across the Sri Lankan bond market. That dollar bond due in April 2024 now trading at just 39 cents on the dollar, Kriti.
Yeah, Kaylee, that risk-off sentiment, it is clearly translating into early trading, at least when it comes to stock futures. And you can see that in the 1.5% decline you're already seeing in futures. And just in the last 30 minutes, you've seen that really accelerate. We started off, I believe, the European session, Anna, can expand on this. But we start off the European session about flat. So this conviction selling really is coming online from European traders and potentially American traders who are getting an early start to their morning. Nevertheless, take a look at what's happening with the Treasury market. Bonds taking a little bit of a bid. The yield down by 5 basis points. And that risk-off momentum, you can see it really translating into crude down 1% and Bitcoin as well down 0.8%. Now, in a volatility-adjusted context, I love to say this, those aren't massive moves, but the fact that it is tilting downwards tells you that already some of that stock sentiment, it is filtering into some of the other assets, Anna.
Yeah, Critty, to your point, sentiment has been worsening as we've been going through the first couple of hours of the European trading day, and some of this is backward looking. We closed down here in Europe, down 1.5% or so on those big benchmarks of European stocks, and so we had some catching up to do, perhaps, with some of the U.S. Wall Street story. But some of this is forward looking as well, and as we've seen U.S. futures weaken, we've also weakened here in Europe. So down by more than 2% on the CAC 40, the FTSE 100, and the Xetra DAX over in Germany. And in terms of those sectors to the fore, all sectors are in negative territory today, but no surprise that we see retail doing really badly today. We also see personal care, that grocery sector, anything that's really consumer facing. Those are the areas where we're seeing some weakness coming through. And so it's that sector that is down by 3.4% today. Here's a stock specific for you, but it does tap into some broader themes. Royal Mail, parcel delivery business here in the UK, as the name suggests, that stock down by 12%. They missed earnings estimates, and that again is another theme that we're increasingly talking about as we've gone through the most recent part of the earnings story. Missed estimates, also warning that they won't be delivering so many COVID-19 tests to people's homes. They won't be delivering so many parcels, lockdown parcels to people, and that plays badly for the business, of course. I wanted to put in what's going on the Swiss franc. This is the Swiss franc rallying up by 1.3% against the US dollar. We're seeking havens today, seeking havens in the bond market. We see that here on the German Bund yield, seeking havens there, also seeking havens in FX around the yen, around the Swiss franc, not interestingly, Kaylee, around the dollar. That phase where the dollar acts as a haven, as we were watching interest rates go higher, we seem to have turned a corner to a new phase where it's all about growth, something they've been talking about on the Markets Live blog for some weeks now. Yeah, a growth scare is really what it looks like it's all about today. Now, as for what else is ahead today, Kohl's will be reporting its first quarter earnings before the bell. So another retailer, of course, it fell 11% yesterday in sympathy with the declines we saw in Target. Will be interesting to see how this company is faring in the face of inflationary pressures. Then at 10 a.m. New York time, the Senate Banking Committee will hold a hearing for Michael Barr, President Biden's nominee for the Fed's vice chair for supervision. And finally, speaking of the Fed, Minneapolis Fed President Neil Kashkari will be speaking at 4 p.m. New York time, Creedy.
And U.S. stocks, they are poised to slide further after the benchmarks on Wednesday had their worst day since the 2020 pandemic. That's on concerns about slowing growth amid soaring inflation and tightening policy. Let's break it all down here with Bloomberg's Danny Berger. Danny, a scary and I would say volatile, scary and volatile session. Walk us through what happened and what this means for today's session.
Critty, it does feel like it's becoming less about these incremental stories of big box retailers, of whatever Jay Powell is saying. It feels more like the trend is in, and that trend being 1 step forward, 2 steps back. A sell-off continuing after the worst day in 2 years yesterday, this morning. And for some, this is a feature of what's happening with monetary policy, not necessarily a bug. Jay Powell said it himself earlier in the week that the market sell-off, it's been orderly and the correct response to trying to tighten financial conditions to get inflation under control. And there's some degree that the market is buying that they're buying what they're selling. And to that point, we have seen 10-year break-evens back off from the high of 3%, more than 3%. They've started to drop. So maybe there is an expectation that the Fed can choke off inflation faster than expected. But that means the question doesn't turn into how long does inflation persist for? It's what are the ramifications to growth if indeed we are able to get inflation under control.
And where does this take us on treasuries then, Danny, and the latest thinking here? Because for a long time we concentrated on that bond market sell-off, on the treasury sell-off. We've seen yields rise. And interestingly, we went above 3% yesterday, and that was enough. People stepped in.
Totally. Well, I think that sets it up really nicely because there's 2 aspects to it. And JP Morgan Asset Management's Matt Gorain really sets this out, saying that 1, as you said, gets to 3%. That's enough. There's some technical element to this, that we're on track for the worst bond market rout on record. And so perhaps the low is in, the Fed, all that hawkishness, it's already priced in, so you can go in and buy. The other element to it, which JP Morgan talks about as well, is the growth scare. If we're shifting away from fear of inflation to fear of growth, then all of a sudden bonds look attractive again as a hedge. And I should say these recessionary calls, they're stacking up from JP Morgan, as I say, to Wells Fargo, to Goldman. So it might be an environment where, yet again, bonds work.
Bloomberg's Danny Berger, thank you as always for breaking it down. Let's go from markets to the market players. Gabe Plotkin is shutting down Melvin Capital after the $7.8 billion hedge fund failed to recover from last year's meme stock frenzy. Our global finance correspondent Sonali Basak joins us now for more. Sonali, walk us through what actually happened here, because this was such an important story a year ago. About a year and a half later, a kind of sad end.
Yeah, certainly a sad end. What had happened was, remember, Gabe Plotkin was a star, and he was known for making really amazingly profitable short bets in the middle of a rising market. Then there was the Reddit fuel short squeeze. We knew he lost a lot of money at his hedge fund that month. He was able to recover last year quite a bit, though still ended the year down significantly. Then there was this year. This year really was where things started to topple over, as 23% decline you saw in Melvin's hedge fund through the end of April. Guys, I think the million-dollar question in the room is this going to be the only fund wind down we see this year? Certainly it was a couple of years of pain, but this year you are seeing drawdowns that are much bigger than what you saw at Melvin this year and throughout last year alone.
Yeah, he's certainly not alone. The Tiger Cubs are suffering as well in a big way. That's kind of what's going on in the world of traditional finance, if you will, Sonali. In the world of decentralized finance, the story you and I have been following for weeks now is the utter collapse of Terra USD and Luna. We've been waiting for one man to chime in on this, Mike Novogratz of Galaxy Digital, and finally we have heard from him.
Yeah, Mike Novogratz had been talking about Luna for a long time, but the thing that weighs heavily here about the Luna UST story is not the institutional investors, but how many retail investors were in Luna and UST. And that's what Mike Novogratz had said in an open letter yesterday. There's no good news that in what happened here, and the question here is, how do you move forward when so many people lost their savings in Luna and UST? But I've got to say also, when it comes to Mike Novogratz, he talked about that tattoo, as you saw pictured there, and that being a constant reminder of venture investing requiring humility, which is a lot of things that a lot of big hedge fund managers are feeling right now.
Sonali, thanks very much. Bloomberg's Sonali Basak on a couple of important financial stories, hedge fund stories and crypto there. Now, China has again warned the United States about its increased support for Taiwan. In a phone call with the National Security Advisor Jake Sullivan, China's top diplomat said the U.S. is going down the wrong road, and that could lead to a dangerous situation. Jack Fitzpatrick, Bloomberg government reporter, joins us now from D.C. with more. So China giving this warning. How is this going to go down in the U.S.?
This is a little bit more of the same from China, so it's not a shock. It is strong language, especially the use of the phrase dangerous situation. But it really shows what a priority this is for China to try to push back on the U.S.'s relationship with Taiwan and any increasing support. This was the highest level discussion between the U.S. and China since the Xi Jinping-Joe Biden conversation in March, and President Xi raised the issue then as well. So clearly it's a high priority, something China really wants to push back on. And keep in mind, of course, President Biden at noon today is supposed to start traveling to East Asia, first South Korea and then Japan. And of course, China looms large over anything the president does when he turns his focus to East Asia. So this may not be the last news out of the White House with regard to China. And obviously, Taiwan is the most sensitive topic within U.S.-China relations.
Jack, as you said, China's warning comes as President Biden does prepare for his trip to Asia. What else is on his agenda ahead of his travels?
Before he leaves, he is going to meet with the leaders of Finland and Sweden. President Biden has endorsed their move to try to join NATO. There are some issues with that. Turkey trying to hold it up over issues regarding Swedish support for certain groups, Kurdish groups. So there's a bit of a back and forth. The president is going to meet with the leaders of Finland and Sweden or meet at the White House House with them today. And actually, meanwhile, on that topic, there are conversations between U.S. Secretary of State Tony Blinken and the Turkish foreign minister regarding that accession process with Finland and Sweden as it relates to NATO. So that is another serious priority, obviously with an eye toward Russia and its invasion of Ukraine and any threats felt by Sweden and Finland's leaders.
All right, Jack Fitzpatrick of Bloomberg Government in Washington for us. Thank you so much. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. A big underperformer in early hours is Cisco Systems. It reported after the bell yesterday, and it warned that revenue could fall up to 5.5% in the current quarter. The company blaming a few supply-side challenges, including the COVID-19 situation in China, as well as the war in Ukraine. They say that will weigh on sales, and that stock getting weighed down heavily in early hours this morning, down almost 14% before the bell. And of course, the big earnings-related mover yesterday was Target. Had its worst day since Black Monday, 1987, after it cut its forecast. It was down a whopping 25% in the Wednesday session. On this Thursday morning in early hours, it's down another 2%. So no relief is coming in this morning. And of course, Target also weighed on some of its retailing peers in yesterday's session. That included Kohl's, which fell 11%. It's going to be reporting its earnings in just a couple of hours later on this morning. But ahead of that report, it already said that two of its executives, its chief marketing officer and chief merchandising officer, are going to be leaving the company effective immediately. So before it's even reported, Anna, that stock already is down about 5% before the bell.
Yeah, absolutely. Really perfect voice to talk to about all of these market moves coming up on the program. We'll talk about the stock sell-off with Matt Maley, Miller Tabak, Chief Market Strategist. If yesterday was all around concerns around the U.S. consumer and retail, well, the Cisco numbers certainly reminding us that there's also the China worries, the Ukraine concerns out there as well. We'll also speak to John McLean, Brandywine Global Portfolio Manager for High Yield and Corporate Credit Strategies. What clues are we getting there as to whether we're headed for a hard landing for the U.S. or global economy? Plus, high inflation and disrupted supply chains from Russia's invasion of Ukraine and China's COVID-0 curbs could just be the start. Today's big take story assesses the damage that would stem from an accelerated reversal of globalization. Read more by typing NI Big Take into your terminal. This is Bloomberg.
City of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Breaking news on NATO. Turkish President Recep Tayyip Erdogan says that Turkey will say no to the addition of Sweden and Finland to the alliance. This is according to a video he has posted on Twitter. Erdogan saying that Turkey will not make the same mistake as with Greece on NATO, again saying that he will vote no for these two countries entering the alliance. And of course, Creedy, President Biden will be meeting with Finland's president and the Swedish Prime Minister at the White House later today. So I'm sure we will continue to get developments on this story throughout this Thursday.
Yeah, Kaylee, lots of geopolitics at play. And of course, we know Turkey has a very long history with Greece, so we've got to take everything with a little bit of a grain of salt. But let's bring it back to the markets here, because that sell-off, it does continue. But I want to look at it from a valuations perspective. For our radio audience, stick with me here. When we're talking about selling off from the stock market, specifically in tech, one of the big concerns, or one of the perhaps topics that wasn't really in the conversation, was what is tech valued in this era of thematic trading? Do we really care what the valuations are when they simply play this role as a safe haven? Well, we care now, because those valuations are coming back now globally to similar valuations to consumer staple stocks. So that defensive play that's in tech has kind of moved that defensive play in consumer staples. It's interesting as we see what actually is going to catch people's attention and get investors to buy the dip again. And for that conversation, let's bring in a true expert, Noor Al-Ali, our Bloomberg Markets Live editor. She joins us now. Noor, let me put that to you. We're in this kind of fear-driven environment. What will it take to see the dip buyers emerge?
It's going to take a lot, and there's not a lot out there that's going to help the dip buyers to emerge. I think some sentiment might be swayed if you see valuations really trickle down. A lot of people will tell you, oh my God, look at these valuations. We were dying for them just a couple of months ago, and now they're here. So there is some perception of that, but I'm not very hopeful, because you do have quantitative tightening beginning in June. So we haven't even really started with the push from the Fed to limit the money supply that's in the market. And I mean, you are looking at some old tech pros. So IBM actually year to date up 2%. So some hopefulness maybe there.
Noor, good morning. What seemed notable at the start of the European trading day was we were starting to sell off, and that's gained momentum. We're now selling off more and more across European stocks this morning. But it seemed to be a stock story. Now it's very much an FX story as well. So the havens that we've had, the dollar has played such a role as a haven in recent months. But that's changed. And that's something I know the Markets Live team have been talking about a lot, the role that the dollar will play. Now we're buying the yen, even buying the euro, even buying the pound, and buying the Swiss franc.
Yeah, I'm not too hopeful about the pound, but look, Japanese yen, absolutely very interesting story there. Swiss franc rallying on its own merits as well, because we are assuming that the central bank governor there is going to use a stronger Swiss franc to pull up rates. And, you know, when you look at the yen right now, there's not a lot out there. The dollar has definitely lost that steam that we've been looking at for the past year. So the FX market is definitely leading it, going back to those traditional havens that we're used to.
Where else are we seeing that show up, Noor? Are bonds once again acting as they are designed to in a 60
moment? But I'm not too hopeful when it comes to the bond market either. But right now when I look at the markets, I say this is a volatility play. You know, if you're able to know where the volumes are going to go and where the tides are headed, you can come out a winner here. But right now, I think bonds are definitely going to extend declines. I know that I've got some of my peers in the team who probably think that we've bottomed out in some of these shorter end maturities, but I think we're definitely going to see the pain coming into the summer even more.
Okay, it takes at least two views, many more perhaps. Noor, thank you very much. Thanks for joining us. Noor Al-Ali of Bloomberg Markets Live. And for more market analysis, check out the Markets Live blog, MLIV Go. That is the function to use on your terminal. They have been talking about this changing role for the dollar for some time, and I know they'd love to hear from you. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Kriti Gupta in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. Sri Lanka has fallen into default for the first time in its history. Policymakers had flagged to creditors that it would not be able to make payments within the grace period. Sri Lanka's government has been struggling to halt an economic meltdown that has prompted mass protests and a political crisis. Authorities warn that inflation may hit 40% later this year. President Joe Biden has invoked emergency powers under the Defense Production Act to try to boost production of baby formula. He's also ordered that government planes be used for imports. The baby formula shortage has emerged as the latest crisis for the White House. It's been months in the making and could ease soon when production restarts at a key plant. Senate Democrats want President Biden to go big with student loan forgiveness. Senate Majority Leader Chuck Schumer and Senators Elizabeth Warren and Raphael Warnock met with the president at the White House. They want $50,000 in student loan relief. That's 5 times what the president has indicated he would support. And the world's richest person saw his wealth shrink by more than $12 billion in just one day. Tesla fell to the lowest level this year yesterday, knocking Elon Musk's fortune down below $210 billion. Musk has lost $49 billion since launching his bid for Twitter last month. In part, investors in Tesla are concerned about how Musk will fund the Twitter bid, but the wider market sell-off also has played a role. And of course, Anna, that is a sell-off that is continuing this morning and one we're going to discuss more coming up.
Yeah, absolutely. That sell-off continuing here in Europe. We're down by more than 2% on the stock 600. So those losses gaining momentum as we go through the European session. US futures also pointing lower by more than 1% on all of the major indexes. We will discuss that with Matt Maley, Military Bank Chief Market Strategist, from concerns around US retail and the profits of US retailers to a broader growth concern that seems to be gripping markets. What happens next? We'll talk about that. This is Bloomberg.
it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. No end to the sell-off after that $1.5 trillion meltdown. US futures signal it will be another tough day for those holding stocks. European stocks are also in the red. There's growing concern that soaring inflation is hurting corporate earnings. Gabe Plotkin is shutting down his $7.8 billion hedge fund, Melvin Capital Management. More than a year ago, the fund was hammered in a GameStop short squeeze by amateur traders who organized on Reddit. It never fully recovered. And a warning from Beijing. China tells the US its increased support for Taiwan will lead to a dangerous situation. Earlier this week, the top American naval officer said Taiwan must prepare itself against potential Chinese aggression through military deterrence. I'm Anna Edwards in London with Chrissy Gupta and Kaylee Lyons over in New York. Matt Miller is off today. And Chrissy, after the pain in retail, it started in retail, went broader than that, of course, hit big tech in the US, and then it went global. And now there's just a general concern about global growth.
Yeah, well, the decline continues today, and this is interesting because after such a big decline that we saw yesterday, the natural assumption here is that you would see something of a rebound just in terms of pure technical plays, but you aren't actually seeing that. In fact, you are seeing a decline of 1.5%. It brings us back to the volatility of a couple of weeks ago. We did have a few weeks of perhaps a little more calm in the markets, but nevertheless, today it is a risk-off tone. But here's what's different about the selling that you haven't seen in past months. The 10-year yield continues to catch a bid, or continues to drop. I say treasuries continue to catch a bid. 282 on the 10-year yield, down 5 basis points. And look what's following it, the dollar. This is important as we talk about foreign investors hopping into the U.S. stock market. Traditionally, as you start to see stocks drop or futures drop, you would see a stronger dollar, essentially disincentivizing investors to hop into the market. Now the dollar is actually following the yield dynamics instead of anything else. So this is going to be a really crucial beacon to watch. But to really cement that risk-off feeling, let's take a big look at Bitcoin, our ultimate risk-off sentiment indicator, down 1.2%, Kaylee.
All right, Creedy, well, let's take a look beneath the surface as well, because there is some real pain out there in the equity market at the individual stock level, including for Cisco Systems, which reported earnings after the bell yesterday. Of course, reporting into a pretty tough market. Sentiment already was pretty dire, and then the company saying that revenue could fall as much as 5.5% in the current quarter didn't go over so well. Of course, it's blaming China and the war in Ukraine for supply-side challenges as the reason why. Nonetheless, the stock is down 14% in early hours as a result. And of course, you had Target down 25% in yesterday's session, its worst day since Black Monday after cutting its forecast. Those losses continuing this morning, but the stock down the better part of 2%, and that is rippling through to other retailers, including Kohl's, which was down 11% yesterday. It's down another another almost 6% this morning before its results. And of course, ahead of those results, announced that 2 of its key executives are departing. And then finally, Creedy was talking about how that rippled, and Anna was as well, rippled from retail through to big tech. And once again, you are seeing technology stocks under pressure in early hours. Apple is down about 1.5% before the bell, Anna.
And Kaylee, here in Europe, we're seeing all sectors under pressure to varying degrees, of course. Utilities a little bit more resilient, but all sectors in the red. And we see the Stock 600 down by just over 2%. So factoring in a little bit of yesterday's move here in Europe, yesterday on Wall Street, putting that into the European context, but also looking at those US futures and responding accordingly. There is broadly a concern around global growth. There's also a concern about consumers in the US and here in Europe now as to how they stand up with these inflation or stand up to these inflation pressures. And just to untangle some of the acronyms on here. This is personal care, drugs and grocery stores. And that is a sector all in one together here in Europe, and it is weaker by 3.6% today. It's consumer-facing businesses, that and retail, that are doing badly in this session in particular. Financial services, though, also not doing particularly well with the sell-off that we're seeing in stocks. This is the Swiss franc gaining, and as we were hearing from Chrissy, we're not seeing money going into the dollar. It seems that haven play that the dollar was performing, or that haven role it was performing, that's changed a little bit in recent days as we've started to be more concerned about growth and maybe the inflation and the higher rates environment. And the higher rates environment certainly something we need to not lose sight of. But at the moment, it's taking a pause as we're seeing buying of treasuries, we're seeing buying of sovereigns, and we see that down here with the German Bund as a result of it being a bit of a haven play for us this morning. Then, Kaylee.
Yeah, markets behaving as you would expect they would in a risk-off day. So that raises the question of whether or not this is really capitulation. Joining us now is Matt Maley, Chief Market Strategist at Miller Tabak. Matt, thanks for waking up early for us. When you look at these markets, yes, it has been painful. Yes, the worst day for equities in more than 2 years is nothing to sneeze at. Yet I'm looking at a VIX that's still at a 32 handle. Yes, relatively elevated compared to history, but it's not a blowout like we've seen in the past. Things look pretty orderly. So how far away are we from real capitulation?
Yeah, it's one of the things. The last thing you want to hear is that it's a disaster, but an orderly disaster. You kind of want that, that big capitulation washout move. The one thing we did see a little bit of that yesterday was the breadth. The advances versus decliners was very, very negative yesterday. So that's starting to give us a sign that, it was 50 to 1 in the NASDAQ 100 and like 30 to 1 in the S&P 500. Those very, very bad numbers. However, the volume really wasn't all that big. And so it wasn't anywhere near as big as even just last week. And so we really haven't had that big washout move. Now, can we get a bounce? So, of course, we can get one anytime soon. It does look like we want to retest those intraday lows from last week, and we've already broken the closing lows, but the intraday lows, and we'll see if we get a little bit of a double bottom. But now this news out of Walmart and Target has really got people focusing on what earnings are going to look like for the rest of this year, and that's starting people really concern people.
And yet, Matt, the bulls are still the bulls. Marko Kolanovic over at JP Morgan saying that stocks can climb out of this hole. We can get there. We can do it. Where are you in that camp? How optimistic are you?
Well, I just think that, it's going to be very, very difficult. I mean, one of the things that I've been talking about for a while is that you go back from what the, all the big firms on Wall Street, Goldman, because they cut their GDP estimates again this weekend, but, they've cut since last October, they've cut their GDP forecast in half. And that's pretty much what everybody on Wall Street has done. However, nobody's cut their earnings estimates. I mean, how can you cut your numbers in half and not cut your earnings estimates? And now what we see what the impact that inflation is having on margins, people realize this is going to be something that's going to have to happen. And therefore, even though the market has revalued itself, it may have to revalue more because the E part of the PE ratio is going to come down.
Matt, good to see you. I wonder where you think this goes next, because if you're looking at the earnings stories that the market has really moved on, and you've cited some of them around retail, that's been a big concern, and how the consumer holds up in the face of higher inflation and how those margins hold up in that sector. But then we got numbers from Cisco overnight underscoring that there are other challenges out there. They were citing concerns about China and what that's going to do to their ability to generate sales. How concerned are you that this doesn't just stop with concerns about US retail?
Yeah, I definitely agree. And what we're talking about here is that, again, we have a situation where the Fed was too late in pulling in its horns last year. They were wrong about being transitory in inflation. However, things have gotten even worse, and they really couldn't have foreseen the not just a war in Ukraine, but a war of attrition. That means oil prices and food prices are going to stay higher, and it's going to have an impact on the supply chain issue. Then, of course, now we have China with the new lockdown, so that's another thing on the supply chain issue. I mean, remember this time last year, everybody was saying the supply chain issue wouldn't be a problem after 2021. Now we're saying it's going to go into 2023. So you're absolutely right, Anna. It's an issue that's broad-based.
Okay, so we keep focusing on that. And with all of these headwinds in mind, Matt, I mean, is it, and with what we know about the Fed and how laser-focused they are on inflation, it seems maybe silly to ask you about whether there's a Fed put here. But if there isn't a level of stock sell-off that would trigger the Fed to change course, if they're okay with stocks looking like they're heading into a bear market, if they're okay with that, is there a level of maybe something happening in high yield or something happening in credit spreads that we need to watch out for that might trigger the Fed to change course?
You mentioned high yield, and you're spot on with that, because this is one of the things that, again, I've been talking about all year, is that people made the mistake of saying that, hey, back in 2018, the Fed pivoted when the stock market was down. They didn't. That's actually not accurate. And I've been talking about this for months, is that in 2018, in December of 2018, the stock market was down 13%. And they went ahead and raised rates again. They didn't care about the stock market. It wasn't until just a few weeks later that the high yield market really started to implode. That's when they started to freeze up there. That's when they really started to change their stance. So, again, I guess my point is, yes, there's a put out there. It's lower, but they are market dependent, but they're fixed income or bond market dependent much more than they are stock market dependent. The stock market can go down quite a bit without really hurting the economy. When the bond market starts freezing up, that's when you have the problems. And right now, the bond markets, even though they've gotten hit quite hard, they're still running quite fine. And that's, again, that's a concern that they'll let it fall further still.
A very key point, Matt. One of the consequences of that Fed put that you were just discussing was this: there is no alternative kind of mentality. I'm curious, though, if that returns in the face of potential recession in Europe and these COVID lockdowns in China. Do we start to see the American stock market just rally off of purely capital flows?
Well, I mean, it certainly could, and we can see what's going on with the dollar. It continues to hold up. Not just hold up, but rally nicely. And as you mentioned earlier, the issue, people are now the dollar was the flight to safety rule, the flight to safety trade. Now we're seeing it in the bond market as well, with bond yields coming down and bond prices moving up, because again, that's something where people are more comfortable with. The U.S. Treasuries are backed by the full faith and credit of the United States government, and that's why they like that. And it's interesting, too, we still haven't seen a bid in gold. It's been holding up here above 1,800. I don't know if it'll rally further, but, there's been a traditional flight to safety trade. It hasn't been yet. But at some point here, I would think gold would catch a bid as well.
Just up 0.5% this morning. Matt, thank you very much. Thanks for joining us. Matt Maley of Miller Tabak giving us his thoughts on the sell-off that's been and perhaps still to come. Coming up on the program, we'll get to a conversation. We'll dive deeper into those comments we were just hearing there about credit. John McClain joins us. Brandywine, a global portfolio manager for high yield and corporate credit strategies. Great voice to get on a day like today. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta and Kaylee Lines over in New York. Now, Goldman Sachs CEO David Solomon says clients are preparing for slowing growth and a decline in asset prices thanks to high inflation. And he warned that if the tumult spilled over into credit spreads, it would be, quote, concerning. Joining us now to talk about credit spreads, John McClain, Brandywine Global Portfolio Manager. So it's interesting to see someone like David Solomon saying that that's, you know, something he's watching for. That's what he's focused on, as many people look around to see if we're seeing signs of recession. Do you see things in credit markets that make you concerned about a U.S. or global recession?
Well, I do think credit markets are very important here, and credit spreads are the canary in the coal mine because the Fed doesn't care about your 401k, but they do care about functioning credit markets. So as we are seeing spreads starting to widen, accelerate on that widening, I think that definitely bears attention. You know, we would say that, you know, probably 650, 700 basis points in terms of spread and high yield is where I think the Fed is going to be really paying close attention.
Okay, and where are we now then, John? Where are we away? How far are we away from that? And what kind of reaction function would that bring about in the Fed, do you think?
Yeah, so I mean, we're rapidly approaching 500 basis points, and really outside of COVID, the last time we got to 500 basis points was really the end of 2018. So we don't see that type of level, you know, very, very frequently in the marketplace. And I think what it brings out in terms of the Fed is the potential for the Fed to slow down the hawkish rhetoric. But, you know, I think credit markets are trying to feel out the Fed put as well.
But John, the Fed wants tighter financial conditions. So I guess how do you tell where the line is between where wider spreads are a good thing for the Fed or a bad thing?
It's really where trading and liquidity break down in the marketplace. I think that's what's important to pay attention to. And so if you see bid-ask spreads widen out materially, I mean, you go back to COVID, you couldn't trade treasuries. There were 5-point bid-ask spreads in the most liquid types of markets in the world. And so everything kind of breaks down when the base asset for valuation of any other risk asset breaks down. So I think really it's the underlying trading liquidity conditions. Dealers step away from the marketplace. Market participants are facing outflows. You know, that's what, you know, an unorderly unwinding is what we're going to be paying attention to.
All right, John, so for a lot of this year, where the sell-off was concentrated wasn't so much in quality, it was in duration. It was about how far out in maturity-wise you were looking. Is it now shifting back to quality?
Yes, absolutely. You know, in high yield, and we've been talking to investors a lot about this opportunity in high yield, really the high quality segment, the double B part of the market, which is more than 50% of the market, was selling off because for the first time, we actually had rate sensitive paper in high yield, these lower coupon, longer duration type assets, and triple C yield to call paper. That was the consensus trade coming into 2022 was to be shorter duration, to be lower down in terms of credit quality, but that has been rapidly unwinding. And the unwind is a function of two things. One, it's a function of fundamentals deteriorating in the marketplace, but two, it's really investors selling what they can and selling things that aren't down as much as the overall marketplace. But that'll quickly correct itself.
John, you mentioned that high yield trade. I think a lot of that was also simply a function of the extremely high energy prices that we were seeing as well. As we start to see this conversation of scarcity, whether it's food scarcity or simply commodity scarcity, do you think that that high yield trade, the CCC, essentially the energy players, become a no-brainer trade when it comes to the credit market?
Well, we've been overweight energy, for some time here, and we still see a lot of value. And high yield's one of those asset classes that is overexposed, with energy being roughly about 13%. But actually, most of those energy producers now that are in high yield are actually double B. They used to be CCC. They've been upgraded pretty rapidly here, and most of the largest capital stacks, you can think of companies like Occidental or Apache, will most likely migrate to investment grade within the next 12 to 18 months. So for the first time in a long time, high yield energy has actually been a meaningful tailwind for the asset class. But yeah, I mean, we still feel very constructive on the underlying oil and natural gas commodities. And these companies are, really focused on return of capital, but living within CapEx. And the living within CapEx and in fact, underinvesting really is a dramatic shift from a management priority from what we saw leading up to the 2014, 2015 oil price collapse.
All right, John, so that's your view on one sector. Let's get your view on one company in particular. That would be Twitter. There is a question as to whether Elon Musk's $44 billion deal will actually go through. But if it does, there is $13 billion in debt attached to that. So this is a company that could be looking at, $1 billion in annual interest expenses almost. What is your thought? What are your thoughts around that capital structure?
Yeah, I mean, math's hard even for a rocket scientist, I think. But, you're right. Look, if we're using prevailing interest rates for single B and triple C issuers here, you are probably at roughly $1 billion of interest costs. And if you annualize the CapEx from the last quarter, obviously not giving guidance anymore, you're talking about $640 million of CapEx. So CapEx and interest costs north of $1.5 billion. This company that really hasn't gotten to that type of EBITDA level. So it's a tough capital stack. Twitter made sense when they were in a net cash position with de minimis interest costs, because it's a business that has really struggled to figure out how to monetize its customer. So, we would say that this is pretty challenging here. And what you're seeing is non-traditional lenders kind of come into the space to help facilitate this debt stack. And that speaks to Musk's creativity.
Yeah, absolutely. Creative. He also has a few rocket scientists on hand to ask, doesn't he, John? So that's useful. Thanks very much, John, for joining us. John McClain of Brandywine Global, thank you so much for your time. Coming up later today, Vanguard's chief economist and head of investment strategy, Joseph Davis. That's at 1:30 p.m. in New York, 6:30 p.m. here in London. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta and Kaylee Lyons in New York. Tom Keene, co-anchor of Bloomberg Surveillance, also joins us this hour. And what a great, what an incredible period in the markets. And I'm really fascinated to see what your single best chart contributes to the market conversation today. Good morning, Tom.
Good morning, Anna. This is a chart that's been out there for ages. I've been using it really since the beginning of the pandemic. A definition of a broader equity index. Correction, negative 10%. Bear market is in negative 18 or negative 20 in the literature. This is the Dow. I use the Dow because it's the emotional grab for most of America. And I know SPX is more accurate. Down we go. The yellow line is correction. We've blown through that as of the close. We're halfway to bear market. You need about a 3% move, Anna, on a drawdown from negative 15 to get you to Dow bear market. We're heading there quickly.
So, Tom, who are you going to ask about the market sell-off this morning?
Well, we're going to talk to a lot of people. I mean, I think it's very, very important to line up a cross-section of people. This is really important. We're going to talk to bond people about the equity market and equity people like John Stolfus of Oppenheimer and Company about the bond market. They're linked. The other thing I'd note this morning is Swiss franc has finally moved. Swiss franc safe haven. That's an important tea leaf.
Yeah, the haven, not the dollar this morning. Thank you so much to Tom Keene, co-anchor of Bloomberg Surveillance. Looking forward to those conversations over the next 3 hours. Now, what else are we looking forward to today? I will be keeping a close eye on Kohl's earnings. Of course, this stock fell in tandem with Target yesterday, down 11% in the Wednesday session. It's off another 7% or so in pre-market before it even reports. Kriti, how much is it dealing with the same inflationary headwinds as we saw Walmart and Target dealing with? And also, what does that do to the activist investor concerns that are involved with this company in particular? Will be really interesting to see as they report into what is a very, very tough tape, with futures down about 1.5% at this point.
A very, very tough tape. Also a very, very tough eco environment as we talk about simply the jobs market. Still extremely tight. I'm watching initial jobless claims and the Philly Fed business outlook, both coming up at 8:30 a.m., Anna.
Yeah, absolutely. I mean, the jobs picture, the only good news out there, but is it, you know, how tight is too tight? I'll be watching the G7 finance ministers. They're meeting in Bonn. Interesting to see what they say about aid to Ukraine, of course. They've had very warm words, lots of messages of support in the past, but will there be actual cold, hard cash behind those warm words to go with that today? We'll also be looking for what they have to say about FX markets. Of course, the strong dollar had been a headache for many of the other G7 until recently. Is that changing a little bit in markets? As Tom said, we see the Swiss franc and the yen. Those are the havens today. That's it for this program. Surveillance is next.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
What we're seeing this quarter is the consumers pushing back. They're saying you can't raise prices.
Inflation, it's high. It's not going to be back to the 2% target anytime soon.
The overwhelming urge, as Jerome Powell stated yesterday, to continue to fight inflation can create a reasonable amount of volatility.
If anything, the risk is that they raise more than what you see priced in the market right now.
We still put the possibility of a recession by end of 2023 at around 30%.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Absolutely brutal. Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures down another 1.6% on the S&P. TK, the NASDAQ, down by 1.8.
And the VIX are two big figures, John, and you're really getting out there. 30 is that level of brutal as you just described it. We're out to 33.02, and anything up in the 40 level is the beginning of that cathartic wipeout that everybody's been calling for. Did we get there yesterday? No. With today's action, we're getting there.
Tom, what do you make of the gloom on the south side this morning? Deutsche Bank, we are at the recession crossroads. HSBC, those gross risks are right now. Barclays, the risks are firmly to the downside.
When you own equities with a 3-year or longer time horizon, this is supposed to happen. We've got a global Wall Street, John, that has no history of a bond bear market. We're in one big time, and minimal history of true equity sell down, not negative 18%, but John, negative 25, negative 35%. I'm not saying we're going to see that, but that's when you get the emotion.
This is not your regular correction if you're looking at Target down
agree.
25% yesterday. Lisa, Dollar Tree down by 14.5%. Costco down by 12.5%. Best Buy down by 10.5%. Amazon, all of this yesterday at the close yesterday, down by more than 7 percentage points. That's a problem.
This is a concern about margin pressures and margin compression that we've been expecting to see, and suddenly we do see. Here's what I don't understand about what you were just talking about, the increasing gloom on Wall Street and how that's translating, frankly, into a bid for bonds right now. I don't understand how people are basically saying we're going to be done with this in the short term, and then we can move on and go back to the old order, because right now what we're seeing at a lot of these retailers is a stickier inflation that's going to have a more persistent effect, and a Fed that has to combat that.
Base case on the street right now is near-term risk ugly. over 12 months, you get a relief rally into year-end and things get better. Deutsche Bank captured this perfectly. Yesterday evening, Binky Charter came out with a note, 36.50 in the near term, price target on the S&P, but the base case hasn't changed. The base case, ultimately, is earnings are still decent, into year-end relief rally, bit of a trim of the year-end price target. They come in from 52.50, but 47.50 is the price target right now at Deutsche Bank. Lisa, 47.50 sounds pretty bullish to me, considering where we are.
And frankly, this speaks to the lack of capitulation that Tom was just talking about. And I was speaking with a very big hedge fund manager last night who was basically saying, we have not seen capitulation.
Wait. You were talking with Ken Griffin last night?
I was not speaking with Ken Griffin.
You saw him at Famous Famiglia, I know.
Looking forward, there is a concern about how to deal with the interest rate sensitivity of a market that does not know what to do with 3 or potentially 4% yields on a 10-year.
We're working out what to do with this. The S&P 500 down another 1.5%. On the Nasdaq 100 down by 1.6%. Let's whip through this price action. That's equities. Here's a look at bonds. Yields 281.72. 2 Mondays ago, 320 on a 10-year. Now about 40 basis points firmly south of that level. In the FX market against the dollar, pretty much everything stronger in G10. Euro dollar just south of 105. At least we're at 104.96.
Yeah, and a lot of people watching this, especially ahead of, in a couple weeks' time, that ECB meeting. Today, the retail earnings do continue. We get Kohl's before the market opens and Ross Stores around 4 p.m. Eastern time at the close. This follows Target yesterday down about 25%, the biggest drawdown going back to 1987. As you both were talking about, how much do we continue to see these margin pressures? How much is this a shift in the mix of goods versus people really staying away from bigger ticket items and leaving a lot of these retailers in disarray with inventories that don't fit the demand of the moment? Today we get a slew of economic data, including U.S. initial jobless claims at 8:30 a.m., April existing home sales at 10 a.m. What I am looking at is the breakdown. Where are the potential layoffs within the cuts that we see with the initial jobless claims? We're not going to get a lot of them. It's going to talk to a tight labor market. But what about the construction workers? We have seen recently an increase in construction workers that have been laid off as we do see less momentum in the housing market. Does that persist? What does that portend? And President Biden is focusing on shoring up all of his alliances today. We see that with Sweden and Finland leaders joining him at the White House, talking about their bid to join NATO and potential other alliances that they can make. And President Biden is then heading to South Korea and to Japan to kick off the Indo-Pacific Economic Framework. This comes, John, as we get a lot of words out of China about Taiwan. What is the next shoe to drop in this geopolitical melee that we have here?
I know, Bramo. Thank you, Lisa. Thanks. TK, right now, this administration and society facing some real wealth destruction coming out of this equity market. Then you've got the issue with energy prices, gas prices as well. This is a really tough moment for this White House.
It's a White House moment, but also a global moment, John. It's going to be a huge theme for me at Davos. I actually was on the phone yesterday with the World Economic Forum talking about the set of totally unusual risks. I actually, John, cut a person off in the middle of the conversation. Heaven forbid, John, I know you're shocked that I did that. And I burst out, I said, do you understand there's a war in Ukraine? There is. Here's the data point right now, John, that sums the risk. Euro Swissy is almost 4 standard deviations from +2 weak Swiss to -2 strong Swiss in 2 days. That is a new safe haven field.
Joining us now is Max Kettner, the Chief Multi-Asset Strategist at HSBC. Max, your point, your lead point this morning is that this growth shock is right now. It's not 12 months out. It's right now. What you've also got to help me with, though, is that your S&P 500 price target, yes, it's come in from 4,900, but it's still 44.50. So can you reconcile the two things for us this morning, Max?
Yes, good morning, John. I guess, in terms of the growth shock, there is a temptation, really, to say that we've probably got another 12 to 18 months time to go, and then things will turn eventually, so there's no real risk on the earnings side. The risk right now is that when we look at equities so far, the derating that has happened was purely really a function of valuations. It was purely a function of multiples. On the earnings side of things, nothing has really happened so far, right? If we look at earnings estimates for this year, they've barely budged for global equities overall. They're pretty much flat year to date. Now, when we look at some of those sectors, consumer discretionary, tech, particularly industrials, they're looking at increases year over year of 15 to 20%, which looks illusionary, wishful thinking, la la land, take your pick, right? It looks just outrageously too bullish on the earnings estimate side of things. What we do, however, think is if we do get that growth shock now being priced in, which looks quite likely that is going to happen over the summer months, and then we start the end of Q3, Q4 in an environment where China will have stimulated a little bit more. The credit impulse has already turned. Growth expectations, particularly top down, will have been slashed even more. So the bar to beat, the bar for positive activity surprises, is very, very low then. Perhaps even more people got sucked into the long dollar trade then. So financial conditions will then probably have sort of maxed out then. And perhaps by then, we'll see perhaps a little bit more evidence of the Fed pausing once they're at neutral. And all that should be giving a tailwind, however, not really in the next 4 to 5 months. It's way too early to position for that. But from the end of Q3, Q4, that's when we're really starting to get a few more positives coming through.
Max, how much does your constructive view down the line, not in the next 3 to 6 months, but perhaps 12 months' time, really rely on basically the Fed blinking, right, and actually pausing, like you say, and not going as far as they say that they're going to go, and seeing inflation roll over in a way that we're not yet seeing it or any signs of it?
Yeah, I think quite a lot, right? It is obviously a mix of things, right? It's a mix of activity surprises perhaps starting to be more positive, expectations coming down, more stimulus out of China, dollar perhaps rolling over at some point, all those sorts of things in combination with the Fed. But perhaps the Fed and the Fed put eventually is probably the most important one. I guess the big risk scenario is that by come September, we're roughly at neutral perhaps on the Fed funds rate. And then the Fed says, well, actually, we might have seen a growth shock, but we haven't seen anything in terms of inflation data rolling over. What Powell was saying yesterday, we haven't seen any sort of evidence of that yet.
Yeah.
So our second mandate, unemployment growth mandate, will keep that in the background. We cannot be here for markets or growth now. That means we're going to go full Volcker style, and that would probably be sort of the bear case, S&P down to 3,000. In our view, really, it's sort of we think that over the summer, the S&P could touch down to around about 3,600. And that would be pricing equities versus rates, for example, for recessionary territory, well into recessionary territory over the summer. And thereafter, things could be a little bit better.
Max, just to jump in with a final question, sir. Credit to you, first of all. You've been very, very cautious through most of this year, so upfront credit to you. Just want to build on this. There's a lot of people, I think, receiving the same information from Wall Street at the moment. It's that near-term cautious, long-term relief rally, which essentially is what you're calling for, Max. For many people still in this market holding on, they're seeing the losses pile up week after week after week for the last 7 weeks. Max, what's your advice to them as they sit there, hugging the index still, getting absolutely hammered, hearing people on Wall Street say, near term, yeah, this is a mess, but long-term relief rally?
Yeah, it's a very interesting point you make, because what we are doing is we're tracking actually positioning across the largest real money accounts worldwide. And what we have seen in the last couple of months is not capitulation. What we have seen is back to hugging the benchmark across everything, across IG credit, high yield credit, duration equities, across everything. Get back to neutral everywhere. What that tells you is that the near-term pain could be so severe that you just cannot look through it. You cannot simply say, well, over the next 12 to 18 months, eventually it should be better. So let me just write this out by being neutral. I do think when we look at parts of credit, particularly dollar credit, there really isn't enough pain in there yet, right? Triple Cs have started moving. But both, let's say, if we look at spread differentials, triple Bs against single As, or even still triple Cs against double As, they are nowhere near recessionary territory yet. So there needs to be more pain, and that's why people hugging the benchmark is not sufficient.
It's a difficult moment, Max. It's super difficult, buddy. And it's great to catch up. Max Kenner there of HSBC. Bramo, credit, spreads, just starting to break out a bit now.
Yeah, that's the right way to characterize it. Not yet recessionary territories, as Max was saying, but you're starting to get the feel that people are getting nervous.
Futures down 1.4% on the S&P, on the Nasdaq down a similar amount. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. China's top diplomat has again warned the U.S. about its increased support for Taiwan. In a phone call with National Security Advisor Jake Sullivan, Yang Jiechi said the U.S. is going down the wrong road and that could lead to a dangerous situation. Earlier this week, the top American naval officer said Taiwan must prepare itself against potential Chinese aggression through military deterrence. And the world's richest person saw his wealth shrink by more than $12 billion in just one day. Tesla fell to the lowest level this year, knocking Elon Musk's fortune down below $210 billion. Musk has lost $49 billion since launching his bid for Twitter last month. Part of that is due to the wider market sell-off, plus investors in Tesla are concerned about how Musk will fund that Twitter bid. President Joe Biden has invoked emergency powers under the Defense Production Act to try to boost production of baby formula. He's also ordered that government planes be used for imports. The baby formula shortage has emerged as the latest crisis for the White House. It's been months in the making and could ease soon when production restarts at a key plant. And Sri Lanka has fallen into default for the first time in its history. Policymakers had flagged to creditors that it wouldn't be able to make payments within the grace period. Sri Lanka's government has been struggling to halt an economic meltdown that has prompted mass protests and a political crisis. Authorities warn that inflation may hit 40%. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now. We are dying slowly but surely, and our lifespan is reducing every day.
stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Earnings season continues.
There's so much nervousness in the market right now.
This market punches you in the face.
Bloomberg is fastest with the numbers and analysis.
Big numbers from Disney.
It just slammed expectations.
Bloomberg, the fastest numbers and analysis you trust.
Well, I think it's very useful to front load our policy settings at the moment. We did 50 at our last meeting, and it's extremely likely that 50 at the next meeting and, probably thereafter.
That was Charles Evans sitting down with Michael McKee. Charles Evans, the Chicago Fed president from New York City this morning. Good morning. This market feels like you're getting punched in the face every single day. Futures down about 1.4% on the S&P. On the NASDAQ, we're down 1.5%. Yields come in. That inverse correlation between treasuries and equities sticks. So treasuries rallying, yields lower by 6 basis points. Tom, your 10-year, 281.90.
It's Thursday, John. This weekend, are we going to begin to see people talk not about July 27 meeting, but the meeting before that?
I don't think so, Tom.
We're pulling it back.
I think that's what's interesting about all of this. So far, I'm not going to predict the future. I'm just going to go on what we've heard.
So far, it hasn't happened.
So far, it's not happened.
Yeah,
and if I go back to what I think was the most important Fed speak we've had in the last couple of weeks, and I promised I'd say it repeatedly, it's what we heard from Mary Daly of the San Francisco Fed.
Yes.
When she said, I expect financial conditions to tighten more. I leave this quote on my computer almost every day at the moment. I would like to see continued tightening of financial conditions. Now, I want to go back to what Goldman said. This is why Goldman have a 3-month price target of just 4,000. They think we're capped here because any rally in equity markets is considered a loosening of financial conditions and perhaps perceived by the Federal Reserve as an unwarranted loosening of financial conditions. That's the struggle in this equity market. We've gone from a put from the Fed and now almost, for some at least, for some, with a ceiling.
John, we don't have the time for it here, but we're through one standard deviation on the Bloomberg Financial Conditions Index. And I'm sorry, if that continues down and breaks through about a 1.20, that's a big deal. And maybe we see, even into this weekend, a change in the dialogue. All of that wrapped around international relations. Mark Champion owns the high ground. He is in Glasgow, Scotland, which I can't pronounce as well as John Farrow. And Jack Fitzpatrick, who knows how to pronounce Glasgow, is in Washington. Mark, I got to go to Jack on the Biden trip because, Jack, to me, it is absolutely hilarious how we're turning TPP into IPEF. Secretary Clinton, I'm against the Trans-Pacific, whatever it was, TPP. President Trump, I'm against TPP. And all of a sudden, we've got the Indo-PEF. Jack, what's going on here?
That may not be the absolute main focus of this trip. It's going to be interesting to see exactly how they sort out the Biden administration stance on trade, although really what the White House officials have previewed for us regarding this trip is that China and sort of trying to make a display of unity among democratic countries is a major focus. So I don't know necessarily that we'll get all the answers on trade policy looking to Asia, although clearly the sort of saber-rattling comments from the Chinese diplomat regarding Taiwan are a major focus, and that's seemingly the sort of top of the docket for President Biden's trip to Korea and Japan.
What is the best outcome coming back? I mean, if we begin to talk about a one-term presidency, Congress is dead set against TPP of a couple years ago. Mr. Trump scored major points with that. What's his best outcome when he returns on Air Force One?
I don't know that they necessarily have a list of goals that they think they can check off that are concrete goals after this trip. The president's focus on East Asia is a little bit more nebulous than that. As I mentioned, kind of sending the right message to China and setting some sort of long-term stance and understanding there seems to be the biggest, broadest goal. So I'm not sure they're going to be coming back saying, we have this and that and this accomplishment at the end of this trip.
Meanwhile, Mark, before President Biden leaves, he's going to be meeting with the heads of Sweden and Finland about their bid to join NATO. We know that Turkey has been a sticking point. What does Turkey want, and how far away is that concession to get Sweden and Finland into NATO?
Right. Well, Turkey has been at odds, really, with the US and a number of other NATO members, including Germany, about the treatment of the Kurds. From the Turkish standpoint, some of the Kurdish groups that the Americans fought alongside with in Syria, and increasingly also the political representations of Kurds within Turkey, whose leaders are now in jail. These are all grouped together by the Turkish leadership, who considers them essentially terrorists. Some of them are listed terrorists, both in Turkey and in the US and elsewhere, including Sweden. Others are not. But because the Swedes traditionally have been a kind of safe haven for refugees from conflicts and from oppressive political systems, that the harder conditions have become for the Kurds in Turkey, the more have gone to places like Sweden, and they've been harbored there. And so essentially what Erdogan is saying, if you want to join NATO, you're going to have to see the Kurdish issue the way that we do. You're going to have to say that you do so. And that is actually politically difficult within the Swedish political system, because there are Kurdish representatives who are quite important to a fragile coalition. So it is tricky. Most of the diplomats involved seem to believe that a solution will be found. But Erdogan is not always a team player within NATO, or he has a pretty prickly relationship with the US already. So it's not quite predictable.
Mark Champion, thank you. Jack Fitzpatrick, to you as well. What a tough moment on so many fronts. Crude right now, Brent, 108.22, negative 0.8%. TK, WTI, 108.08. We're down about 1.4%.
Churning, and I would say the same for the dollar as well, with a 103.48 on DXY. There's a lot of things to watch here, John, because we're all driven now by the equity markets and to an extent the bond market. But this is where, with the Bloomberg and going cross-asset, as we heard from Max Kettner with HSBC, you look at the nuances of the moment. My nuance this morning is the safe havenness of the last 24 hours. You like that?
What do you make of the rally then, Tom, in the Aussie? The fact the Aussie's up. It just feels like a weaker dollar story this morning, for me at least, against the whole of G10.
Yeah, I think it's a weaker dollar story, but it's fractional. Within the 2 standard deviation study, it's within the band, it's contained. If it goes further, yes, that's a big deal.
Relationship between bonds and equities has reestablished itself, Lisa, over the last few weeks. You see yields down, equities a whole lot lower.
I don't really understand this. I'll be really honest. It seems like right now the market thinks that the Fed's going to blink. You can see two-year yields actually dipping a little bit. It's sort of the whole Max Kettner view of the world, that inflation will come down enough and that, frankly, growth will slow enough for the Fed to back away. The rhetoric is going in the opposite direction.
Isn't that the hope at the back end of summer? I just hear it so many times from so many different banks. Goldman, HSBC, Deutsche Bank. The base case is a rough 3 months, and then the Fed backs off and things get better.
Yeah, predicated on them blinking. And they're saying, we're not going to blink. This is a new moment.
Futures, it looks ugly. The Nasdaq down 1.4% after a pretty brutal session yesterday. From New York, this is Bloomberg.
companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
From New York City this morning. Good morning to you. Pretty ugly price action yesterday. The follow-through -2 on the S&P 500, down by 1.4%. On the NASDAQ 100, we're down about 1.5%. Deutsche Bank says we're at the recession crossroads. Barclays say risk remain tilted firmly to the downside. And HSBC and Max Kettner about 30 minutes ago, said the growth shock is right now, not 12 months out. It's right now. For Deutsche Bank, they've got an interesting call. In the long end, things get better, relief rally, you'll hear that a lot on Wall Street. In the near term, the average recessionary decline, Binky Chawla did some work on this, is -24% on the S&P. So that would take us down to 3650. That's the near-term call from Deutsche Bank, just to price in the average recessionary decline of 24% on the S&P. Something to think about as we work our way through this market and work our way through what many people consider to be, will be, an ugly summer. At the moment, what has reestablished itself is the relationship between this, the equity market, and this, the bond market. The push-pull continues. 2s, 10s, and 30s. Your 10-year yield comes in about 5 or 6 basis points. Again, yields lower, 282.62. Just to think about the levels more recently, Tom. 2 Mondays ago, 320.
Exactly.
Yields all the way in.
John,
2-year yields, we topped out this year at about 285. Tom, right now, 262.19.
John, 2 glasses of Tang ago, we were at 3% in the 10-year yield. We've moved 18 beeps in a glass of Tang.
And reestablished that relationship that we're used to, that negative correlation between equities and treasuries. Equities down, treasuries up. Lisa, yields lower.
Which means that people expect that inflation to come down, and for the Fed, especially because of the front-end action, is not going to raise rates as much as they say. Is the data backing that up? I'll leave that to other people to decide.
Growth right now dominating the story, not growth equities, growth fears. Let's finish on the last board, euro-dollar. Euro-dollar at the moment going into a really important meeting. How many times have we said that for this ECB? Euro-dollar 105, that currency pair positive 0.4%. Just across the board in G10, TK, you're seeing some dollar weakness emerge on a session this morning.
Target weakness this morning as well. Don't know where it is right now, but Joe Feldman with us yesterday with Telsey Advisory Group. This is an example of what you're seeing on the street. He maintains outperform on target, but lowers the price target big time, from a 305 down to 200. Those are the micro adjustments being made. Patrick Pelfrey is co-head of quantitative research and senior equity strategist at Credit Suisse and is looking at the macro adjustments. How are you using the micro changes of your sell-side research team, Patrick, this morning?
Well, when we talk with our analysts and we go through the transcripts and we look at where earnings estimates are moving, everything on the fundamental front seems very much intact. 2022 estimates continue to rise. There's certain sectors, communications in particular, which is seeing pressure. But generally speaking, estimates are holding up quite well, including revenues. Margins a little bit less weaker, but still enough to propel the earnings forward in a meaningful way.
This is important, folks, because Credit Suisse hit the ball out of the park 18 months ago with a wonderful barbell strategy of bullishness. Patrick, if you've got a constructive view like that, are we over-focusing on margins and not looking at a pretty good or good revenue lift based on nominal GDP?
Well, Tommy, I think you're absolutely right. Companies live in a nominal world. I know as economists, individuals like to talk about real activity and they like to piece out inflation, but companies, for the most part, don't really matter. They are oftentimes in